Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's August 9th, 2019, episode 40. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we're joined by Tony Zhang from Options Play, and then a special return visit from Barton, where he gives us a TGA update. For our WTF segment, Kramer and Mr. Wonderful complain about them meddling kids.
And then this week's trading history, we go back to Volcker becoming Fed chair, and then we hit the top 5 things to watch this week. So let's jump right into it.
Lena, hop on.
Hello.
Hello. So what do we got?
So this week we're sponsored by New Glarus Brewing Company's Spotted Cow. This is a Wisconsin beer.
Right.
So
now I do want to correct one thing here. So last time we were doing the Fantasy Factory beer, I said that was a Wisconsin-only beer. It was from Wisconsin, but it is actually the Spotted Cow beer that can only be purchased in Wisconsin. And so it's an employee-owned brewery, and they essentially refuse to allow the beer to leave the state. And so you actually
we have a legal contraband here. I like it.
Yes. So we are in Toronto, Canada, drinking a Wisconsin-only beer. So let's
right.
give it a go. Let's see what we think.
Okay, let's go. Okay, so this is such a huge improvement from last week, although that wasn't saying much after you got us that sour. But this is a nice beer. I like this, Patrick. I like it.
Yeah, it's a nice, smooth drinking ale, right? It's not bad. I'm gonna need a couple of these to keep me going. Because
what do you think,
these
Lena?
12-ounce beers. What do you think, Lena?
This is really nice and smooth. That we even forgot to read the description of the beer.
Oh yeah, Lena, do your magic. Do your magic.
Give us a description.
Naturally cloudy, we allow the yeast to remain in the bottle to enhance fullness of flavors, which cannot be duplicated otherwise. Expect this ale to be fun, fruity, and satisfying. You know you're in Wisconsin when you see the Spotted Cow.
Nice.
Fun, fruity, and satisfying. Patrick, that's you, buddy.
Well, thank you very much, Kevin. All right.
Okay.
All right, so let's get on with the show. Oh, actually, no, Kev, you need to give us a disclaimer, don't you, buddy?
I do. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include part-timers, mean reds, and or empirism.
All right, Kev. That was great. Thank you very much. All right, let's jump in and get our guest on here. Okay, so joining us now is Tony Zhang. How you doing, Tony?
Good, Patrick. Thank you so much for having me.
No problem. So, listen, we're looking forward to taking a deep dive into the trade wars and some of your stock ideas in a moment. But I understand that you're going to join us with a nice beverage. What are you drinking?
I'm actually going to start off with Highlight, which is a pale ale from a brewery in Tampa called Cigar City. I don't know if you guys ever heard of this. It's one of my favorite IPAs. It's
nice.
It's out of Tampa. I don't know if you guys ever make it down there, but they have it everywhere now.
Well, listen, you know what? You got to. I guess you can't really bring that up to Toronto when you're here in September, can you? But next time I'm down in New York or something, you'll have to give me the name and I'll quickly grab one of those. Anyway, so and then what else are you drinking? You drinking anything else?
I think I will follow that up with a Balvenie peated cask. I'm a big fan of the peaty scotches, so I have two different preferences for scotches. I like the Madeira and port casks, and then I really like the really, really peaty stuff, so Lagavulin, that type of stuff. So I'm on the Balvenie peated cask today.
Wasn't that like a so for those of our listeners, we've been drinking before with all these different scotches when we were out in Montreal. It was one of these peaty ones that you gave me, wasn't it?
Yeah, we
Remember
were
what we were
drinking. We were drinking the Johnny Double Black, which is the blended whiskey from Johnny Walker.
It was very nice.
That was from some pretty peaty stuff. Yeah, but this one's more peaty. I love the really peaty stuff. For those of you that like that kind of scotch, what are you drinking?
Right. Well, we're drinking. No, we're not. We'll edit that out. What the fuck are we drinking? That's what I'm drinking right now.
Spotted Cow, Wisconsin.
There we go. Okay. Yeah, we're drinking. Lena, can you mark that?
Don't edit it out.
Oh, don't edit it out. No.
Okay, let's talk some markets. Tony, what do you got for us?
So today, I want to talk about the trade wars and the Fed cuts because, as a strategist, this has been a bit of a challenging environment to trade. We've had these periods of extreme calm followed by these violent corrections. We saw that in December 2018. Are we starting to see some of that again? Is kind of the question. And we really want to talk a little bit about this ping pong that we're currently seeing in the markets between the Fed cutting interest rates and then immediately Trump slapping on some tariffs. And the question is, who wins in all of this? Is the Fed cuts stronger and will bring markets higher, or do the tariffs, hurt the markets further and bring us, lower? So that's what I want to discuss here today.
Right. And so we have this chart here up on the S&P. So you're just trying to show the levels here, right?
Yeah, I think 295 was kind of that line in the sand prior to the sell-off. The fact that we managed to get above it was certainly starting to look like we were getting back into a bullish phase. And then, we had this correction back below it, this violent correction. We got to whip back up to that 295. Looks like that got rejected as of yesterday and today. So, I really think that this is probably headed a little lower, at least down to that 272, 260 level. Our potential targets is the downside for the short side, for the short run.
Right. And so, what's your thinking here? Like, what do you think of this mid-cycle adjustment language? Do you think that there's more rate cuts to come here?
I actually have this in one of the next slides, but this I believe is the first of many rate cuts to come. The market is already pricing in at least 2 to 3 more rate cuts between now and the middle of next year. So I definitely think that that's potentially, coming down the line. This was the first rate cut we've seen since 2008, during what is relatively strong economic times, which is not something that we typically see.
Right. And so what's your thinking here on the trade war escalation, though?
So, what I find kind of scary is the fact that, the second the Fed cuts interest rates and potentially provides a boost for the markets, Trump comes in and raises tariffs. And he's been doing this almost as he has been doing this as a way to get China to bow to his demands, if you will. And this is a dangerous game because, as you can see here on this chart, we've got this massive escalation of tariffs. In September 1st, we have potentially going up to 6%. And the fact that this is across consumer goods is kind of the scary part in terms of what's next. Are we talking about more tariffs? Are we talking about tariffs for Vietnam or even automobiles? These are things that we've kind of left off the table. But, in this trajectory, I think anything is possible. And I think that's really the scary part that we're heading into.
Right. And then so you were looking at that from like a feedback loop mechanism where is this the game that Trump is playing in your mind, like in terms of when he's making the choice for putting these tariffs on?
Well, I certainly think the timing of these round of tariffs were I don't think it was coincidence that it was announced right after the Fed cutting interest rates. So yes, we're seeing this feedback loop, and this is really the dangerous thing that I want to talk about is the fact that when the Fed eases, we get this feedback loop. And if you can move on to the next slide, I'll talk a little bit about what this looks like. So right now, the trade war is continuing to escalate. Right now the concerns are whether or not we're going to get higher tariffs across more goods, and even in countries like Vietnam, where a lot of that trade is shifting to. And the fact that the market is pricing in more rate cuts. So does that mean that Trump is going to potentially put in more tariffs, and that's kind of the thing that I want to take a look at. And I think the best way to take a look at this is kind of cutting out the noise and actually looking at some of the economic data that I think the Fed is really looking at to make their decisions.
Right. So what do you think are some of those major inputs in your mind?
So, if we look at it globally, things are certainly slowing down, right? If you look at GDP pretty much globally, things are slowing down. US, China, Britain, for a lot of emerging market countries, we're seeing some slowdown on here. In the US, non-farm payrolls, we're really starting to creep down to that 2013 level, which we haven't seen for quite some time. Businesses are more cautious about investments. A lot of the industrial indicators are particularly weak. So if you look at the next slide, global automobiles are near all-time lows since 2008. These are all things these are not, in my opinion, showing any form of recession per se. And the next slide is another indicator that we typically look at. The 10-year, 3-month Treasury yield has certainly gone negative. Again, these are all signs. It doesn't mean that it doesn't mean that we're in a recession, doesn't mean necessarily we're headed into a recession, but it simply just means that everything is slowing down. And the next slide, I have one on GDP. We had a recent revision for last year's GDP from 3% to 2.5%. That's a pretty big move to the downside. So if you look at the downside risks of a recession on the next slide, well, that's certainly ticking higher. So these are all things that are kind of that we're looking at that suggest that it makes sense to potentially. Or what we're seeing is that the Fed is really trying to get ahead of this and this slowdown, and that's why they're cutting interest rates. But with Trump throwing tariffs here in the wrenches, if you will, this is really what is concerning, at least for me. I don't know what your thoughts are about this, but I think the best way to really look at this is actually thinking about game theory. I don't know if you guys ever have studied game theory, but it's very clear to me that the global trade game that we're all trying to play is clearly an infinite game, meaning there's no winners in a global trade. It's whoever can survive the longest. And the winner is really the person who manages to stay in the game for the longest. And Trump is clearly not playing that game. He's playing a finite game. He thinks he can win this game. And there's no such thing as winning this game. And China seems to be on the other side. China seems to be playing this long game. They're playing it slow. They're not taking any shots. They're waiting for Trump to do something before they do anything in return, and they kind of, I feel that they kind of feel they see that as long as they continue to just wait it out, that it's likely that Trump is actually going to hurt himself from the perspective of, more tariffs are going to hurt the markets, which are going to hurt his chances of being reelected. And at the end of the day, he can only be in office for another 6 more years, which obviously is a very long time. But I think China is thinking the long game here.
Right.
But Tony, it's Kev. I'm going to jump in here. But haven't the Chinese kind of noticed that the tide has shifted in America? And whereas before it was only Trump that was behind the whole idea of, worrying about the Chinese situation, we're seeing more and more the Democrats and other political parties grabbing hold of the idea that China's not playing fair, and the idea that you might, wait out Trump is no longer kind of an actual outcome that China might be able to do.
You're absolutely right. And, and there are certain things that China have done for a very long time that I don't think America should allow, such as all the theft of intellectual property, right? That's always been a very, very big problem. But has China moved or budged on that at all? I don't think so. And this is really the part that I'm concerned about, is whether or not, China has any interest in really responding to that.
So now, if that's correct, and they don't have any interest, and Trump is going to continue to escalate it, do you think it resolves itself with a market crash? And if there is, do you think it hurts China more than the U.S., or just there's nothing but losers all around the table?
So my point is that I actually think that in this particular case, it's really everybody loses. These two world leaders are fighting with each other, and at the end of the day, we all lose, right? And the scary part is the fact that central banks across the world are responding to this, right? We've just in the last few weeks, we've had the Philippines, we had Peru, we had India, Thailand, New Zealand, all cutting rates. This is unprecedented in the fact that if you look at Germany, look at Switzerland. All of their bonds are negative yielding already. And this is when things are okay. So what is going to happen when things really hit the fan? We're going to cut rates. We're going to cut rates to zero. We're going to go into QE. Historically, we've cut rates by about 5% going into a recession. Now we're already at 2%. So where do we go? Do U.S. interest rates become negative across the entire curve? I think I don't think that's necessarily a high probability, but I think that's actually probable. That's something that we don't have a textbook for. What if all U.S. bonds were all negative yielding? What do we do then? I don't know.
Well, Patrick would be taking us all out for dinner because he'd be loving it so much.
Why? Is that something you predict?
Well, not necessarily negative interest rates, but I think interest rates are going much lower. Gravitating to zero, I think, is the better way of saying it. I don't know if I'm going to drink the Kool-Aid that we're going to see negative in the U.S., but anything's possible, I guess. But
Patrick, you're not bullish enough, buddy. You're not bullish enough.
Oh, there you go. So I'm going to ask you this question though. All right. So I mean, Tony, you were kind of straddling the line as to non-committal. So I want all three of us an over/under binary, yes or no. Is there a recession before the elections next year? Starting with you, Tony. Yes or no?
I'd say yes.
All right, Kevin.
Yeah, I actually am in. Yeah.
Oh my God, we're all in consensus. This is gonna be awful.
Yeah, it won't happen.
So listen, everyone. There's no recession coming. We whenever we all agree, it's do the opposite.
Yeah, I don't want to be this doom and gloom kind of thing, right? On the next slide, I do want to talk about positioning, right? So when I'm a big fan of relative strength. I use relative strength very heavily in my trading in terms of understanding where to position. And still, domestic equities, U.S. domestic equities, still is the strongest asset class in the whole world right now, above international equities, fixed income, everything else. We do see cash starting to become slightly more, or not the least, or is not the weakest asset class anymore. So, I do think that it's time to start positioning into slightly more cash, especially in some of your non-performing assets. And I do think that it's time to start thinking about buying some puts or hedging for your long equity positions. I don't like buying puts ahead of time, trying to anticipate, a downside. But I do start, the fact that we cracked below that 295 level, this is telling me that, this is time to start looking at those types of trades. As far as a hedge goes, I always say it's better to be late than early, because if you buy puts early, you're going to end up creating a huge drag on your portfolio that's very expensive. Wait till the markets start correcting before you buy puts. It'll be expensive, but it'll be worth it.
All right, so you're basically saying pay the higher vol premium, but be late, right?
Exactly.
That's interesting. I have a little bit of different philosophy, but I mean, that's what makes a market, isn't it?
Yeah.
But that's interesting. So you have some other trade ideas for us in terms of sectors. What's on your mind?
So as far as, if you look at the fact that I'd love to get into marijuana stocks, but I just have one thing to say about where I think there's still some opportunity, with respect to the trade war, right? Because this last set of tariffs is specifically targeting consumer goods, and consumer goods is really the one bright spot that we currently see in the economy, out of the economic numbers. Consumer retail has actually been really, really strong. So if you look at the stocks that have exposure to China versus stocks that don't, I really see some bifurcation that you have potentially opportunities on the retail side that have sold off the last few days, that have a fairly small amount of exposure to China versus the stocks that have a high amount of exposure to China. So those are some of the opportunities that I currently see going in the market. With that, let's jump into marijuana stocks.
All right. So what's on your mind here?
So I was just looking at a marijuana index, and I saw that we're starting to see a bit of a bottom forming out in marijuana stocks, because we've really had this huge sell-off over the last pretty much 6 to 8 months in marijuana stocks. So pretty much across the board, growers, distributors. The only bright spot really has been kind of on the Scott's Miracle Grow, like the fertilizer companies, some of the pharmaceutical companies. But if you look at any of the major cannabis companies, they've all had this huge sell-off. And the question is whether or not we're starting to see a bit of a bottom. From a chart perspective, we're starting to see higher lows, which is the first thing that we typically look for a potential bottom. And the question is looking at some of the fundamentals and looking at legalization in Canada as to see if this is starting to become the bottom or starting to become a bit of a turnaround for this market. You guys are in Canada. What do you guys see? Do you guys see people lined up? Last time I was up there in Montreal, I think a couple of months ago, there were people lined up out the door to buy cannabis. Is that still kind of the trends that you guys are seeing up there?
Well, no,
most
people just
those.
use their. Yeah, sure, Patrick. Most people have their dealers, and actually, the interesting thing that's occurred is that the reality is that the legal cannabis market in Canada has not grown nearly as much as everyone would expect, because first of all, the quality hasn't been that good, and the reality is that the private unregulated market is actually that much better. It's been the kind of the strangest thing around. It has not done nearly as well as everyone would have hoped.
Right.
Got it.
But where it is interesting, we have in Canada the Horizons Marijuana Life Sciences ETF, which is the Canadian dollar basket for these cannabis stocks. And we're approaching lows that were established all of last year. Like with all through 2018, we saw this particular ETF testing this kind of $14 to $16 range. So we're definitely approaching what has in the past acted like a support. Will this be a turn point? It is certainly no longer near the highs. So it's gotten beaten down almost. Yeah, it might be interesting. What is there particularly something that you're watching within that space?
So what we're seeing is that there's been a lot of headwinds over the last few months, right? So just in June and July, we had some pretty big news come out that were quite bad for the industry. And the Hexo announced that margin and price compression, which is not new at all. This is something that the marijuana industry has been experiencing, I would say, over a year plus now, where just prices have been continuously declining, margins have been declining, and Canopy announced a big earnings miss in June. July, we saw the CEO of Canopy, the largest manufacturer, get pushed out, which was certainly not necessarily great for the industry, but probably good for the financials of that company. Canatrust having that illegal grow facility certainly wasn't good for the industry. So these are all headwinds that we kind of saw that kind of decoupled this industry from the overall market, because for the most part, marijuana traded in line with the overall market until the last few months. In August, we started seeing some earnings beats. So the question is, are these early smaller companies that beat earnings, is that kind of a bit of is that the beginning of a turnaround for some of the larger companies? And what we saw is, Aurora actually they didn't pre-announce. I don't know what they issued a guidance about a month before their actual earnings. So I think their next earnings is on September 11th, actually. And they just announced last week that, they gave some guidance that were really strong. And we saw the stock pop as a result of that. Some of that has come off over the last few days. But, really what we want to look at is kind of the big companies and kind of what we're expecting in 2020, because Canada just released the rules for, if you will, going forward for edibles and vapes, which is kind of the higher margin products. Those are the products that the companies really want to sell. The flower, like you said, the flower is more expensive and it's not as good. But the edibles, the vapes, those are some things that generally speaking, are not as accessible on the black market. So those are some of the, I think, what's going to provide some more opportunities in 2020. Patrick, if you don't mind, just moving on to the next slide.
Yeah.
So what we started doing is we started digging into some of these marijuana companies. This is just a quick report that we put up together just for ourselves, because doing research on marijuana stocks actually wasn't that easy to know which stocks were even in this category. Because you kind of span everything from the tobacco suppliers that have invested in some of these companies, to the actual growers themselves, to pharmaceutical companies, to companies that provide resources or provide fertilizer to this industry. So there's a lot of different stocks. So we wanted to take a look at the overall industry, and we started to see some interesting trends in terms of stocks that are starting to go above its 20-day moving average. So one of the things that we really see is for 2020 on the next slide is that clear 2020 regulations is good. Clear regulation is good for the industry. It lets people understand as far as what is the potential, because there was a lot of uncertainty around edibles, how the Canadian markets are going to regulate that. I think there's still some uncertainties around how edibles will be in Quebec, but for the most part, there's been rules that have been established, and that's great. And it brings these higher margin products. But compliance with these rules tend to favor the larger players. So if we look at Colorado as a roadmap and trying to see the adoption and growth there, a quarter of the residents there are consumers of marijuana, which is a very large percentage of the residents. Now, even if we apply a fairly conservative approach to that for Canada, we see a lot of growth going into the next 5 years. Colorado saw about 100% growth over the past 5 years. So, as far as the companies that we look at, Aurora and Canopy clearly are the leaders in this particular space. And we think that those are the two companies that will really be able to take advantage of the growth over the next few years. And we think that some of this turnaround was probably going to happen by Q4 this year, or Q1 of next year, where these companies that have large amount of scale will really be able to take advantage of the legalization in Canada. Aurora has established a fairly large footprint, and I think they're going to do fairly well over the next few years as legalization continues. They've provided strong guidance, which is, kind of the shift that we're starting to see towards the upside, that the largest or the second largest cultivator in Canada, and they've really expanded globally. So we really see that there's quite a bit of opportunity from that. Stock, Canopy, same thing. They have the largest scale. We think they're the best capitalized, and they're really going to be able to capture the legalization in both Canada and potentially in the U.S. Canopy has really made some acquisitions within the U.S. space, like Acreage Holdings, that allows them to have a huge footprint within the U.S. if the U.S. is to legalize it on a federal level. But we see some smaller players like Canna Trust, which I in this particular case is a smaller footprint. There's no real international expansion. We don't really see that as an opportunity, but Hexos has a pretty big distribution within Quebec, so we think that they can do quite well there as a small player in this particular space. And lastly, Kronos. Kronos has their partnership with Altria Group. They have a significant amount of cash on hand, and I think if they deploy that well with some mergers and acquisitions, they can really become a leader out of the smaller companies currently. So that's kind of the landscape that we're currently seeing.
So, Tony, I have to ask you, though. I'm sure many of our listeners are asking that same thing. Now, you're a big options guy. Do you particularly express these trades by buying the underlying, or do you use some sort of an options way to play this?
So my preference for these types of longer term plays is actually buying somewhat in the money leaps. They're expensive, but they're certainly cheaper than buying the underlying. Many times you can get about a 4-to-1 leverage on these fairly still expensive stocks to purchase using calls. But buying leaps, I think many times are a good way to get that upside with limited risks to the downside, because these stocks, we have seen these 20-25% pullbacks. Or potentially even larger pullbacks. So to offset that risk, I think a good way to play this is slightly in the money leaps, I think is the best way to play this.
Nice.
Okay, well, Tony, that's some great stuff. Thanks for joining us today. Before we let you go, why don't you tell people where they can find a little bit more about what you do and what you offer, and where they might reach out to talk to you more about this?
Yeah, so again, thank you guys so much for having me on. This has been a great pleasure to talk about the markets while having a drink. Not something I get to do very often. But my name is Tony Zhang. I'm the chief strategist here at Options Play, and we run a company to help individual investors better understand and educate you on how to trade options. You can find us at optionsplay.com, but I do have a special link here at the bottom that allows you to sign up for a free 30-day trial to Options Play, as well as get a free 12-step options trading course to help you get started. So if you're brand new to options trading, or if you're an experienced options trader, we've really designed this from the ground up to either make your options trading experience as simple as possible with respect to learning the beginner stuff, or if you're an advanced trader, we try to make your user experience of finding a trade down from a few minutes down to just a few seconds. So please visit us.
Nice.
And if you have any questions, send me an email, or just sign up for a free trial at that link.
That's terrific. Now, we're not going to let you get off that easy, Tony. Some people have a tale from the trading desk, and I was wondering if you could share one with us.
Yeah, I want to share a story from, this has got to be about 5 or 6 years ago. I used to be a very, very active futures trader, and at the time I was trading just E-minis, which predominantly is what I was trading. And I had a pretty big following on Twitter because I was calling out my trades live and doing fairly well at it. And I had a very specific strategy that I think any futures trader or any big futures trader is probably familiar with, which was trading a strong reversal in a trend. And I had a very specific strategy and a very specific take profit that I would always add to my trades, and a very specific stop loss. And I always place those as one cancels the other. And I can even remember the stop loss that I had was 7 ticks to the downside, and my take profit was 9 ticks to the upside. So I think I was risking somewhere 7 ticks on S&P was just shy of $100, and my take profit was 9 ticks, just a little over $100 per contract. And I was doing a lot of trading, and I was calling out my trades, and I probably was one of those days where I just had a large number of winners. And if you trade S&P futures when things were moving, it wasn't uncommon to have 8, 9, 10 winning trades in a row if you had a good trending day. And one day, as I was on Twitter and I had a pretty big following, one of the biggest futures traders at the time on Twitter, commented on one of the trades that I made. I forget if I was long or short. I called out my entry level, I called out my stop loss, I called out my take profit level, and as the trade started to move against me, I decided to move my stops. And this was always something that, I was taught not to do. But at the time, I was looking at all my indicators and I said, you know what, I'm pretty sure of my directional trade, but I just think that the market might move a couple of ticks, towards my stop loss and then keep going in my direction. So I said, I'm moving my stops because of XYZ. And this guy who, was a pretty well-known futures trader called me out on this. And he said, and he was pretty blunt about it too, and he wasn't really nice about it. He was straight up saying, hey, that's really stupid for you to move your stops. and I really got into it with him on Twitter. And I said, look, I'm following your type of methodology. This is why I decided to move my stops. And I got so caught up in trying to prove to him why it was reasonable for me to move my stops that the trade went against me. I ended up having to put on more of that trade just to try to get back to break even. Next thing I know, as I'm fighting with this guy on Twitter, as I'm moving my stops and adding to my position, which I shouldn't have done, I ended up with my largest loser I've ever had in futures trading because I was so busy fighting with this guy and trying to prove to him that my stop losses should have been moved, that I ended up having the largest loss that I've ever had trading futures. And after that, I didn't trade for like 10 days because I was just so I was just like so mad at the fact that I did that, and I got caught up in trying to fight with this guy, that I didn't stick to my rules. And that was really how I learned my lesson of placing stop losses and sticking to them, and not throwing bad money after good money. And this is something that I really try to teach in my education these days, is telling people how to manage their risk, because that's really by far the most important thing that you have to learn as a trader. It's not your strategy and not how to make money. It's how to manage risk, because that's how you survive as a trader.
That's a great story, Tony. I actually really appreciate that. As a guy that's on Twitter and takes a lot of flack, I know that the temptation sometimes to go and try to argue with people, or that you want to argue with people, and then also the difficulty in going the other way or admitting you were wrong. And sometimes the fact that you are public makes it more difficult to do something. And at the end of the day, you're right. You got to do what you have to do to manage your risk. And it doesn't matter. You shouldn't be on Twitter, arguing with anyone about your positions, because your position should take priority above everything else.
Yeah. No, and it's interesting because that story resonates with me too. Because Tony, I ran a little futures day trading room as well for many years back in my day. And that was the same thing, right? Like anytime you break your rules, once you start like feeling the pressure to make something happen, and you let up on your rules a little bit, the market loves to play that role of the great humiliator and separate you from your money. And so learning to manage that risk is so critical. And you know what? Sometimes you only learn that by doing. I mean, that's I think what makes a veteran trader. A veteran trader is you've touched the stove a couple times and got burnt, and you know that following the rules is so important, right?
Yeah, absolutely. I mean, I think the most important lesson to learn is a humbleness in trading, right? That the markets will stay irrational longer than you can stay solvent. And generally speaking, that statement is more so for long-term investing, but I can't help but think that, even for short-term traders, it is absolutely applicable that you need to be humble as far as trading, and you can't ever think that, oh, I have to be right. That is the kiss of death for any trader.
I agree. Well, thanks for sharing that with us, Tony. Make sure you guys stick around, and we're going to get more of Tony in the after hours. Sorry. Okay, joining us now, we're getting a recurring guest. We get Barton, who is a little bit of a TGA account. And for those who don't know what the TGA is, Barton, why don't you tell us what it is?
Hey, Kevin. First, thank you for having me back. So TGA account is one thing that's very highly related to the debt ceiling that was just being raised a couple of weeks ago. And it's essentially the checking account for the U.S. Treasury that's being hosted in the New York Fed computer. And turns out this is very important. It relates to the pressure selling or buying pressure of equity, US dollar, commodities, and a couple of things. So let's take a quick look at it. If you go to the next page, we first can see how TGA come into play about 11, 12 years ago during the great financial crisis. TGA wasn't a thing until essentially late 2008, early 2009, when the Federal Reserve started to pay interest to the required reserves and the excess reserves. So before that, all of the cash balances of the U.S. Treasury was basically stored in commercial banks. But after that, since Federal Reserve is paying interest to the commercial bank for these cash balances, it doesn't make sense for these billions of dollars to be stored in a commercial bank account. So that's a time when New York Fed started to be the basically custodian or the servicing bank for the U.S. Treasury. And TGA.
So that was right. So that was when they had the introduction of the IOER, which was the interest on excess reserves. Is that correct?
Exactly. That's exactly right. And that's why we only have about 12 years of history to look at for how TGA may impact US dollar as well as equities, for example. So this is two periods in the past when we also had a debt ceiling lift through Congress, highlighted here with these two color regions, one in 2015 and one in 2017. In both times, the TGA account went to very low balance as required by the law. Treasury basically had to spend all their cash because they don't have the authority to issue new debt. And after debt ceiling was lifted, TGA account immediately go up because Treasury like to keep about 150 to 350 billion dollars as rainy day funds for cybersecurity reasons and other reasons, depending on who is the Treasury Secretary. And as we'll see in a few slides, that actually started to create a bit of pressure on the US dollar and SPX. So the lower panel here showing what you're seeing here was US dollar from late 2015 and into today. And those two time period when TGA account went up from like $50 billion to $300 billion was highlighted in yellow and green respectively. And you can see that the dollar index actually raised by about $6. The yellow box on the left, within that 2-3 month period when the TGA was going up, and in 2017, during that ceiling resolution, TGA went up by about $150 billion, and the U.S. Dollar index went up by about $2.4. So that's
okay. So Barton, 1 second, Barton. I'm going to interrupt here just quickly and let's just go through the mechanics of what's happening here so people understand. When they're able to, they issue more debt. So the Federal Reserve or the Federal Reserve is actually taking liquidity out of the system because they're pre-funding some of the debt. Is that correct?
That's exactly right. And I have a few slides, 2-3 slides later after this, and having a clearer picture about what's really going on.
Okay.
So I'm just having a very quick preview here about what's generally happening. And if you look at S&P 500, you can see in 2016 that yellow region, there was also quite a bit of selling pressure on the equity market as well. But in 2017, during that debt ceiling resolution, although TGA went up, nothing seemed to happen to S&P. So the question is why? Why would TGA affect equity and the US dollar differently? And would they affect equity this time or not? And what's really going on? So to understand this, it's useful to take a look at what exactly and how exactly TGA apply pressure to different asset classes. So what you're seeing here is the balance sheet of the Federal Reserve in New York Fed's computer. So on the left-hand side, you have the asset side of the balance sheet, and on the right-hand side is the liability, and they have to be identical in total numbers. And when we do QT and QE, we're basically increasing the total size on both sides. And right now, we're not doing any of those. So the total amount is a constant. So the right-hand side, the liability, whatever grows in one piece or one line item means some other line items or some other piece have to be shrinking in order to vacate some balance sheet space for the other. So in terms of TGA, it's a checking account for the U.S. Treasury. Every single dollar that's going into TGA has to be balanced by a dollar that come out of some other pile of money on the New York Fed's computer. And in this case, most of the time it's coming out of this blue box, which is commercial banks reserves. And this is how TGA apply pressure to US dollar and the equity market, essentially.
Right.
So the detail of this is actually quite intricate because the U.S. Federal Reserve give bank reserve to both bank based in the U.S. or the U.S. branch of foreign banks as well as many foreign banks, like banks in Europe or banks in Japan or even banks in China. And the total bank reserve is split between US banks and foreign banks. So when TGA account balance fluctuates, depending on whether the dollar is coming out of a US bank or a foreign bank, you will start to see a different reaction in the market. If the money is coming out of a foreign bank, you tend to see a huge pressure on US dollar because that's translating into a dollar shortage for the on the euro dollar market, for example. On the other hand, if the dollar is coming out of the US bank, then the pressure is more on the equity market or commodity market. So in this graph, very quickly, you can see that the yellow and then the green time period corresponding to the last two debt ceiling resolution they have different profile on the foreign bank and US bank. And foreign bank basically coughed up more money in 2015, which caused the US dollar to under a lot of pressure to go up. And in 2017, the U.S. banks basically did not suffer much from the TGA account rise, and therefore equity was not affected, and it's more on the U.S. dollar as well. And here you can actually see the sell-off in Q4 2018, which is a blue arrow, when the U.S. bank reserve dropped a lot in the fourth quarter last year, when the foreign banks was not affected as much. And then in this year, 2019, even though it still had a QT for the first half of the year, most of the money came out of the foreign bank's account, which become more of a pressure on the US dollar as opposed to the pressure on the equity market or the crude oil market.
Right. So what are we looking at here on the next slide when you're showing here? Is this still...
So what you're seeing here is the question to answer the question. Okay, if we know there is some correlation, does it mean that this is a tradable information? Every time the TGA account balance goes up, that would translate to a dollar index rise or something like that. It's actually not that simple. For example, the top panel here shows you the TGA account balance in the past 5 years. And there were periods of time, meaning 4 to 6 weeks period, when TGA had a huge amount of inflow in cash, right? So that means either the Treasury is issuing a lot of new debt, or there's a huge amount of tax receipts, which usually happens around April 15th.
Right.
So that's the two arrows you have over there. And if you compare that with the dollar index chart at the bottom, during April of 2015, still previous, 2015 and 2017. 2017 didn't really have much a rise in the dollar index. 2015 did. And the difference between these two different years to the reaction to the TGA account is because of whether the money is coming out of the foreign bank versus money coming out of domestic banks.
So you don't know actually in advance where it's going to come out of. All you know is that the TGA account is going to go up or down. Is that correct?
In principle, yes, but you can make a educated guess about what's going to happen. So if the TGA account fluctuation is coming mostly from income tax or any tax receipt into the U.S. Treasury, most of it will come out of U.S. domestic bank reserve.
Okay.
If it's
if it's coming out because Mnuchin has decided to pre-fund something, then that comes more out of the federal side?
It's
more the foreign side?
Foreign side, or at least 50-50, but more likely foreign side. So what's going to happen very interestingly right now is that for the next couple of weeks in August, when Mnuchin starts to increase TGA balance through issuing T-bills, you will probably see the foreign bank reserve getting affected first. Just like in this slide you're seeing on the screen, the foreign bank's reserve balance basically inversely correlate with the U.S. dollar index.
Right. So if and we know you just told us that Mnuchin's already announced what he's going to do in terms of funding through T-bills, and we know that the TGA account is going to go up. So therefore, are you saying that the dollar should be, all else being equal, more strong going for the rest of the month?
That's more likely than the other way around, meaning dollar being weaker and equity being strong, dollar being weaker and equity being under selling pressure because the U.S. bank loses its reserve. So what's happening is actually through the rest of, if you go to, I think, 2-3 slides down, yes, here. This is my projection of how the TGA account will evolve in the next few weeks. And as you can see here, throughout the rest of August, we're pretty much flat. And the reason for that is we do have an increase in the T-bill issuance, but they're spending it out immediately. And the spending goes into U.S. domestic banks because that's basically Social Security payment, Medicare payments. That's all mostly domestic. So this will be mostly a money transfer from or bank reserve transfer from foreign banks to U.S. banks, most likely. So you'll probably...
Sorry. Well, does that mean that we will likely see a strong U.S. dollar and a stock market that hangs in there, like all else? Would that be your best guess?
Exactly. That would be my best guess.
And then what happens in September? I see that it expands dramatically. It goes from 150 up to 350 over the next 3 weeks. What is that from, and what's happening there, and what do you think is going to happen to both the stock market and the dollar from there?
Right, that's a very good question. So in mid-September, there will be a huge rise in TGA account balance. 2/3 of it coming from the September estimated tax receipt. So there are people who are contractors or self-employed people who are paying for their estimated tax. And then 1/3 of it comes out of the 3-year, 30-year, and 10-year T-notes and T-bond issuance. So that should be mostly being put on, it's going to be a burden on the U.S. domestic banks, and potentially could be an interesting time for stock market to get affected, because this would greatly affect the cash flow of big banks and their ability to lend out money to hedge fund.
Yeah, so we're going to see potentially, and you highlight the fact that it's also the quad witching in the S&P, which won't help that at all. In terms of, and September is traditionally also one of the toughest months out there. Everyone thinks that October is always the ugliest month, but if you look, I think historically, September is almost as bad, if not worse.
Yeah, everything lined up perfectly. All the liquidity withdrawal will happen, but we'll be finished basically a day before the FOMC, Wednesday. This should all be done. TGA will go up to 300 billion. And then we have FOMC, which could introduce volatility to the market. And then you have option expiration, future expiration, and all of the fun stuff. So it'll be a very interesting week to trade.
September is going to be really interesting for sure.
And I think that this TGA is a relative, as you explained, the fact that it's new and it's something that we've only experienced over the last decade. Is something means that a lot of market participants don't really understand it as much as they probably should. And I think that anyone that is all interested have to make sure that they follow Barton, because he is the kind of the man when it comes to understanding these things. And I'm always shocked at the level of detail that you go in. I was joking around that I think that Mnuchin should probably ask you what he thinks the account's going to be, because you probably know better than he does. and he's busy. Him and his wife are busy going around the world spending all their money, while Barton's busy running his spreadsheets and figuring out what it's going to look at. And don't underestimate how important this is in terms of how much it might affect the markets in both the U.S. dollar and the stock market. Because I really think that it is one of the probably one of the best edges you can get out there that is being overlooked by the stock market. Now, so Barton, for those who want to learn a little bit more about you, I guess the best way to find you is Twitter?
Yes, the best way to find me is through Twitter, and here is my Twitter handle, Barton_options. And if you follow me there, I usually post the updates up about the TGA balances and other things related to the Fed account.
And make sure you guys follow him because he's a must go to when it comes to these things. And Barton, I'm going to ask you one last question before you go. So I spent my whole life trading options and stuff like that, and I thought that I knew all the Greeks. And I see you guys talking about Vanna, and I think you're talking about Vanna White, but you're really talking about something else. Why don't you give us a little? Why don't you give us a little 30-second spiel about what Vanna is? Because I see all you Delta heads, the Greek kind of masters talking about Vanna all the time. And why don't you just tell us a little bit about what that is?
Yeah, Vanna is this really interesting second-order Greek. Basically, it tells you how much the delta of an option will change as a function of the implied volatility change. So in other words, when VIX, for example, go up from 12 to 16, that's a 4-volt change, how would that impact the delta of an option? If Vanna is 0.2, that means the option delta will go up by 0.6. And why is this important is sometimes there are lots of options that has a huge amount of Vanna because of the option open interest tend to cluster in certain strikes. And if those strikes are at the highest Vanna region, which typically about 10 delta to 18 delta for puts, then that creates a huge amount of selling or buying pressure when there's a big volatility spike. So for example,
I get it because, sorry, go ahead. I'll let you explain it. Sorry, go ahead.
So we basically experienced that this Monday when we gapped down, I think 50 points, and we had a huge volatility spike in the first, throughout Monday, but in the first 30 minutes of the trading hours, there was a huge amount of delta generated on market makers' book, simply because of the implied volatility of all these options has been raised by many vols. And these market maker has had to delta hedge their book, and as a result, they were selling a huge amount of future and then pushed down the E-mini future prices quite a lot.
Right. I understand what you mean. Like the reality is that let's just assume, here's another way of maybe I can explain it. Let's assume that for some reason, all of a sudden the market became more risky and it didn't move in price, but there was an event that we knew that we should move up the implied volatility of all the options and the volatility that these dealers are going to hedge their book at. You could get a situation where that change in volatility actually creates a delta that must be hedged. If I got it?
That's exactly right. And that also happened yesterday, Thursday, when they crushed the volatility about 5 vol to 6 vol between the 7-day to expiration to 90-day expiration options. And that created a continuous buying force in the market. And you saw the market just went up in a straight line. I think from 2,900 to 2,930 or 2,940.
So there you go. Now we know that Vanna is not Vanna White, and we just want to thank Barton for explaining that again to us. So make sure you give him a follow. You'll learn all about these things, and the TGA account, watch for it and watch for September. Could be a fun and exciting September.
we have to get Barton back here in early September to give us an update where all the numbers are. Because
for sure. Why don't we do that? Well, how about the second week of September, Barton? If you're willing to come back on right before the excitement and while the account's going up, I guess we'll have you on for another update in terms of what the TGA account's looking like. Sound good?
Sounds good. Yeah, I'll see you guys then.
Okay, all terrific. Right. Have a great rest of the summer, and thanks for coming on, Barton.
You too. Take care. Bye-bye.
Bye.
All right, Barton. Thanks a lot.
Is that good?
Thank you. It was perfect. It was a great amount of speed things. I should have warned you on the Vanna, but I figured you knew what you're talking about, that you were going to be fine. That was awesome, buddy. That's exactly what we need.
Yeah, so you have some extra slides. We can always circle back to these.
I can tell you guys what's going to happen. That's something nobody's actually talked about so far. Just seeing like 2 minutes. So if you go further on the slide deck.
Oh, okay. Hold on. Let me pull it up.
Yeah. So this is something really fun, and then it actually happened when the bond market went crazy.
Okay, where do you want me to go? Which
so
slide?
Just go to slide 21, and then zoom in on that. So that's the yield curve, right?
Right.
So what happened was now that 10-year, 5-year, 3 months, all the T-bill, T-notes are below not only IOER but also the repo rate, right?
Right.
Central bank will not buy T-bill, foreign central bank will not buy T-bonds or T-notes anymore. They will just park their money in the Fed for so-called foreign repo pool, which is the savings account for them that's paid the overnight repo rate.
Right, I get it.
So that removes all the a huge number of bidders for the T-bill and T-notes, and then the side effect of this is that the foreign repo pool, so lower panel, plays exactly similar with TGA. It's a line item on Fed's balance sheet. If this grow up, if this number rises, the bank reserve will shrink. So in the past 4 weeks, the foreign repo pool should be flat, but it rose by about $35 billion, which is not good for bank's reserve. This is a stealth QT that's going on. Everybody thought QT is over, but no. Because of the yield curve is so inverted and we're doing IOER, if this trend continues, we're going to see a $30 to $40 billion of a reserve loss from banks every month.
So basically that's saying that the Fed has to lower IOER to get it below that so that the central banks go once again and start buying T-bills.
Yep. So they have to cover.
Yeah, I got it. Yeah. No, I hear what you're saying.
And this is
otherwise, and this is a way to measure it almost.
Yep. And this is going to be, Trump doesn't have to do all the China trade deal stuff.
Well, now we have to keep this in the recording now, so we're not over yet. So the rate cut's coming.
Yes, it is. Well, unless Fed is going to do something radical here, they're going to cap the foreign repo pool. But I haven't seen any sign of they're doing that. I don't know if they.
They're not good. They're not going to do that. They're just going to lower the rate. They're just going to lower the rate.
Right. So basically, how much 5-year and 10-year is going to continue to go down will determine. But essentially they have to follow the 5-year and 10-year, and this is a path to zero very quickly, right? That's my take on this.
Okay, hey Barton, is it okay we leave this in the recording?
Is this polished enough, or?
Yeah, for sure. Why not?
It's a market huddle polish, buddy. It's good enough.
Okay. Well,
but I mean, this is why the market is pricing in the rate cut, isn't it? Like, I mean, arguably, this is why everyone's calling Powell's bluff, isn't it? Like, I mean, it's being baked into the cake at this point, isn't it?
But they're really become a slave of the bond market right now. If this trend continues, I see we might go to zero in like less than 12 months, right?
What?
Yeah. I think, though, what Barton's saying is that this is actually causing stress in the system. Yeah. And he's showing you why with the bond market is actually moving around and will cause problems in the banking system if we trade below the IOER. So that the fact is that they have to get this IOER below the where the actual T-bills are trading. Otherwise, you're going to get this account continuing to grow, and then that will be a problem for risk assets and for banks. Now, would you agree with that, Barton?
Right. That's exactly right. Or they institute their standing repo facility, but that's not going to solve this problem this. It's not going to give you hundreds of billions of dollars of liquidity. It could give you like maybe 20 or 40, but not this much.
Nah, they need to cut, and this is just another sign. Anyways, thanks again, Barton. We'll talk to you in September. Have a great rest of the summer.
You too. Yeah, great talking to you as always.
Thanks,
Okay,
Barton.
take care. Bye-bye.
Cheers. Bye-bye.
Bye-bye.
Okay, Patrick, it's time for This Week in Trading History. What do you got for us?
We have to go to 40 years ago, Kev, when Paul Volcker was actually, he took the office as the Fed chair.
You know what I like best about Paul Volcker? When those pictures of way back when? He's
Cigar.
got a big cigar. Like
Can you imagine trying to pull that off today? Can you imagine, like, Powell walking out into a FOMC conference and he's got a big-ass stogie and he's got smoke just clouding his face. He's like,
he'd probably be vaping these
We're
days,
cutting
though.
interest rates. Got it? It's like a mafia. It's like a mafia scene right out of, like, Godfather or something, isn't it?
I don't know if they were big cigar smokers, but
but it feels like that. I'm not forget
Yeah.
that they were or weren't, but like it feels like that. It's like a mafia scene. Anyway, but Paul Volcker, right? So he took office on all he takes the office of Fed chair on August 6th of 1979. And by the way, he was a giant, wasn't he? Like, I think, was he like 6'6" or something?
Yeah, he's tall. Like, there's no doubt about it.
Like, it was amazing. They showed these pictures of him walking up the stairs of the Fed, and like he's got his assistants beside him, and he's like an entire head higher than everybody else. He was huge. But anyway, so he was the one who did some pretty crazy monetary policy, right? And so what I wanted to do was just go back and actually give everyone a quick kind of rundown of what was going on in the 70s and just like what he had to contend with when he came in, right? Because so there were two central bankers before him, right? The majority of the 1970s was Arthur Burns. Now, you've mentioned, but this is interesting because isn't it amazing how the media generally doesn't go much farther back than Volcker nowadays?
Yeah, I mean, like a lot of people wouldn't even be able to name those two central bankers. I know Arthur Burns because he was the guy that Lyndon Johnson, or was it? Yeah, I think it was Lyndon Johnson, put up and strangled, telling him to go that he was going to cut rates.
Isn't that amazing? Can you imagine today Powell grabbing... sorry, not Powell, but Trump grabbing Powell by the throat and saying, you're going to cut rates?
Although
like, that's the way shit rolled 40 years ago, dude.
But, I know, but it's kind of doing that today. He's just doing it on Twitter. He's doing the social media equivalent. And interestingly enough, Patrick, we're taping this on Friday. Today, I heard, Trump saying to Powell that, not to Powell, but to the market in one of his scrums, that he thought that they should lower rates 100 basis points. He's doing the equivalent. He's doing the social media equivalent of what
of giving him a throat grab.
A throat grab.
But okay, but after Burns, very quickly, was William Miller, right? He was only for 2 years, from 70 to 79, and Volcker took over for him. And so very few people talk about them, but it was the inflation of the 70s, right? And it wasn't hyperinflation. Hyperinflation, you have to. What is the official definition of hyperinflation? Something like 50% in a year or something.
I don't know.
It's some number, but we never saw hyperinflation in the U.S. It was just very high. It was high inflation.
Yeah.
We saw very high inflation. And so that inflation really kicked in the 70s, particularly once the gold standard was removed and we started this new fiat currency era. But we saw inflation rates in the mid-70s hit about 12%, and then again going into 1980 hitting 14+% inflation rates. Can you imagine that happening today?
Yeah, there's no way because that's never going to happen again, Patrick.
Well, okay, maybe in your fantasy land. We're going to bring the other Wisconsin beer, the Fantasy Factory, out for your magic unicorn inflation ride again.
That's right.
But nonetheless, inflation ran, and it was a very oil shock driven inflation back then, was it not? I think
it wasn't, but it was also, don't forget, it was the Vietnam War. They were spending on the war and not raising taxes enough to pay for it. So we had a massive amount of fiscal spending, and that wasn't getting taken out of the system. And
exactly.
And that's what we kind of and people were shocked. And the interesting thing about it was that not only did you get that spending, but you had interest rates that were kept low. So real rates were even lower. Like, so it might look like, yeah, okay, rates were high, but, don't forget during Miller's time, they were pegged at 6 or something, and inflation's running 12. At that point,
crazy.
you have negative 6% real rates.
Right. And so you have inflation literally going, the rate of change to the upside would make would make a guy like Keith McCullough go gaga when he's looking at rate of change shit. Like you basically have it going parabolic to the upside through that 78, 79 period, ending his term as central banker very quickly. And then you bring in the big guns, right? Volcker comes in. And what does he do? He hammers interest rates, right?
He cranks them. Like he cranks them through the roof.
The interest rates, right? Actually, we'll go by these Dow charts, but let's look at these interest rates. So going into 1980, as soon as he takes office, you essentially have interest rates go from being somewhere around 10%. He cranks them to 13% and then up to 17, 18%.
And then, what the funny thing is? They go back down to 9%. And he's then forced to raise them again in 81, and he raises
hits
them
19%.
Like, think about that volatility.
You know what was crazy? It was
dollars.
Just when they put the sanctions onto Russia, and the Russian central bank jumped interest rates to like 17%. I nearly fell out of my seat. And then they go back here and it's like, no, it happened in the U.S. too, right? Like it's crazy, right? Like just seeing, what interest rates were doing in responses. Volcker basically cranked rates to these astronomical levels.
And what, I'm going to interrupt you there, Patrick, for a second, because what was most interesting about that time is even though he was cranking rates, nobody believed that inflation was ever going to be tamed. It was almost the exact opposite of what we have now.
Yeah.
Back then, he was cranking rates, and everyone said, "Nope, you can't. It won't work. There's no way. It's not going to create. It's not going to stop inflation." And it was shocking how little the market believed that he was going to be able to affect things.
Yeah.
And you had guys like Henry Kaufman, who was Dr. Doom, thought that inflation was going to continue forever and there was no way they were going to stop it. And for the next decade, he kept calling for that inflation to go back to those levels, and it didn't.
And he was wrong.
He was wrong.
But you know what's amazing was that this Volcker and his shoot up of interest rates represented, in my mind, the reset of the financial system that allowed the next 40-year bull market to occur. Whether in equities, whether in bonds, everything happened because of this moment. Right? Like when you're starting interest rates at 19%, you're creating a perfect environment for one of the greatest bull markets of all time, right? And if you're in the 1980s and you're Berkshire Hathaway and you're a value investor and you or Templeton and you basically start buying stocks when they're at historically low PE ratios, you basically started the beginning of what was one of the most epic 40-year bull markets of all time, isn't it?
Yeah, because they were priced for death. And as we talked about,
it was priced for death.
Right.
And so let's give all our millennials a quick lesson here on stock markets and inflation-adjusted stock markets, because when people look at a standard nominal price chart of the Dow Jones, they see from 1965 to 1982, this era of 17 plus years, where on a chart it appears that the Dow Jones just stayed flat. It was range bound.
Right. It couldn't get through 1,000, basically.
Everyone perceives that it just can't get through 1,000. It tested 1,000 in 1966,
1, 2, 3, 4, 5
in 1969, in 1973, in 1977, and again in 1981. Like you basically have the Dow Jones hitting 1,000 on 5 occasions and never being able to break. And so everyone's like, oh, well, the market's just stuck in a range. But that is not really what your return was it, Kev?
No, in real terms, it was a lot lower. Because don't forget, during this period, we had inflation running 14%.
Exactly. So when you go and look at a chart, what I'm showing here, and you look at your inflation-adjusted returns of the Dow Jones, we went from the equivalent of 8,000 down to 2000, it was like a 70+% wipeout of the equity purchasing value of your money. It was one of the great bear markets. I mean, you have to go back to 1929 to see a wipeout of equity to this magnitude, right?
Yeah, it was in real terms, it was devastating.
The big difference is, like, if you look at 2008, that was just like a 18-month hiccup. Right, like you can go and you go over a 3 to 5 year time period. Stocks recovered so quickly that most people didn't see the difference if you just had a long enough time horizon. But this is almost a 2-decade bleed out.
Yeah, think about trying to invest in stocks for the long haul. As you can
2 decades of just
think about entering the
hammered.
workforce in 1966, and think about how much conviction you're going to have for the next. It's not
20,
quite 2 decades.
20 years
15 years. Every year for 15 years it goes down. Feels like interest rates today.
But see, that's the beautiful thing about nominal prices is that you see that nominal number. The majority of people can be fooled by that because inflation is that hidden thief, right? That you don't see in a nominal price.
Right, but
you
terms
feel it
of
in your purchasing power.
For sure. So why would you be investing in stocks when that's happened?
Anyway,
don't forget, during this whole time, you could buy a bond that was yielding 10%.
Yeah,
there was at least it was still getting inflated away, but the reality is at least you were earning something.
Back then you buy those long dated bonds. I think a long dated bond didn't have as there was huge disparity in the yield curve, right? Because while on short term money you could get 19%, the long bond didn't trade up to 19.
I think the long bond went to 16
12,
or something. There was a 16,
like 12 or 13. Was there a 16? I
think there was, or maybe it was Canada because I know our rates were higher. We had more problems, but I think there was a 16% like highest coupon 30-year. I think there was something like that. There was some famous issue that was done at the height of the bear market, and it had a huge monster coupon, and it came out, and it was issued at $100 and never saw that again until it expired.
Yeah. Well, you know what? I'm going to stick my neck out. And maybe you can call me an idiot for this. Go ahead and call me. But everyone likes to give Reagan all the credit for all of his fiscal and tax policies and all the other stuff Reagan did. But I honestly think that all the bulls out there should be thanking Volcker for what happened in the 80s and 90s, because I think that by him slamming down inflation and bringing the whole market in, created the environment from which that bull market could have happened. I think he's more responsible than Reagan is. You call me an idiot for that or what? Or you agree?
So one of the things, though, Patrick, about that argument is the fact that you might be giving him too much credit. Because maybe it had something to do with the fact that the oil had spiked, and maybe it had something to do with the fact that they no longer were fighting in Vietnam, and the fiscal side of it came down. And there is an argument to be made that Volcker is kind of lionized by you monetarists as too much of a hero. And I'm not going to try to make that argument because I know you're going to not want any part of that, but that is just something to keep in mind when you're thinking about Paul Volcker.
All right. Anyway, this week in history, August 6, 1979. It's for all of our younger investors that have not studied some monetary history. Going back to the 70s was, and it's funny because we spend a lot of time talking about the Great Depression and all of the devastating things of deflation and that. But understanding the 1970s, I think, is important because it gives you the other side of the coin, how the markets behave in a inflationary period, especially when inflation is running north of 4%, right?
Right.
Anyways,
thanks for that, Patrick. It's great to hear your This Week in Market History.
All right, let's get on to, the WTF clip of the week, though, Kev. And so what do you have in store for us? Give us a setup.
Oh, God, I saw that Trump tweeted out something about Mr. Wonderful. And for those who don't know, Mr. Wonderful is Kevin O'Leary.
Canadian.
Although he seems like maybe some days we don't wish him to be Canadian. He is Canadian, unfortunately. And he actually lives right near me. He's my neighbor, so I have to be careful. Kevin, I'm sure if you're listening to this, You'll be a good sport about it. But anyways, listen, Trump tweeted out something about Mr. Wonderful and Jim Cramer, and I just couldn't take it. I thought I was going to throw up in my mouth as I heard it. So I thought it's got to be a good WTF video. Let's watch it.
The president would like a big win.
And I'd have done it, too, if you kids hadn't come along.
Before the election. Doesn't have to worry right now.
And I'd have found it if it wasn't for you snoopers.
And I think that this whole notion of invincibility with Xi is a little bit more made up by the Western press.
You blasted kids. Why didn't you mind your own business?
And I think it's tiresome. I'm listening to Mr. Wonderful, and I think Mr. Wonderful's dead right on everything because it's factual. It's empirical. And thank you for speaking the truth. I don't know how. Why aren't you more fearful that the media will hate you?
Yes, might have gotten away with it, too. If it wasn't for these blasted kids and their dogs.
You know, Jim, I just have to fight it every day, and I'm really tired of the last 15 years. Finally, an administration that's batting for the guy that puts his capital up there and gets screwed over and over again. Enough already. Let's fix it.
Blasted meddling kids. And it would have been mine if it hadn't been for those meddling kids.
And I would have made millions if it hadn't been for you meddling kids.
Meddling young fools. They've gotten away with a king's ransom.
Couldn't agree more. And that's exactly what's going on. Thank you for speaking the truth. It's really refreshing.
And I wish you'd have minded your own business.
Kev, I was asking Lena. Lena, jump on here. Lena, did you ever watch Scooby-Doo when you were younger, or is that out of your generation?
I've watched a few episodes, but not like I actually loved watching the Smurfs instead. So not a
Yeah,
Scooby-Doo
so you're not a
fan.
Scooby-Doo fan? You know the thing about Scooby-Doo that you don't realize till later is the fact that whatever the blonde guy is that drives the van, he's always sending off Scooby and Shaggy, and then he's taking off with the two girls. What's that about?
There's lots of innuendos in old cartoons,
I know, it's actually kind of funny.
That's funny.
But
you know what? Listen, so what was your narrative here? Like what inspired you to jam and a little bit of Scooby-Doo?
Just when these two old guys, Kevin O'Leary and Jim Cramer, start talking about how thank God for Trump and thank God for him telling it as it is. It just made me think about like some old guy yelling to get off your lawn, or yelling at clouds, or like the one that I would have got away with if it wasn't for you meddling kids. And that's, I don't know. I don't know why. That's what they seem like. They seem like they should be the villains in a Scooby-Doo episode. That's all I'm saying.
Mr. Wonderful. It's a perfect name for a villain in a Scooby-Doo episode, right? Mr. Wonderful.
There you go. I don't know.
Anyway, thanks for sharing, Kevin. All right, let's get on to the top 5 things to watch next week. But before we do, what do? We review.
We go over the 5
week.
things from last week.
All right, so Kev, starting at the bottom, prairie dogs and goochering it, right? And so far, your prairie dog theory seems to be.
You're talking about the U.S. dollar, of course, because at that point you said that you took out your .22 and shot my prairie dog. And I think that was the high in the U.S. dollar. So for all U.S. dollar bulls, you should be aware that Patrick goochered it.
Yeah, I am guilty as charged. It's unbelievable. You, dude, you fucking nailed it. Listen, you don't get many right, but this one. This one,
you know what the thing is, I told you, I even told you ahead of time. I said I'm going to wait for the bull breakout, and then all you guys are going to get really bullish on the U.S. dollar, and I'm going to sell it.
And then you're going to give it to us. I know you did it in several $billion waves.
That's right. Actually, all this is me selling, and it caused the
yeah. I mean, you're a big fish, man. You're just.
Yeah. Take another one lot and another one lot. Anyways, no, I obviously do not move. No, nobody moves the FX market like that. And the reality is that you did it when you goochered it with the 22. That's all there is to it. The market gods did not like that comment, and they did it. So let's move on to number 4, the renminbi.
Oh, yes. Let me quickly revert it upwards because you're going to yell at me. So, so we have here we're clearing the 7 handle pretty clearly.
Yeah.
I mean,
so we're going to stay above 7. Whether this is going to be a big deal or not is another matter, but it's not going down. But the question is, if it can stabilize and just not rise at an accelerated pace, I think everything will be fine that way.
So how do you make sense of, okay, you know, a year or more ago, Hugh Hendry was basically saying it's Armageddon if China devalues 20% tomorrow, and then you have Kyle Bass coming out and basically saying that if they stop supporting it, it'd be 30% lower. Like, I mean, how do you make sense of this kind of talk between two pretty smart people?
Well,
what's your take on it anyway?
I always think that what's really important in financial markets is the speed upon which you do these things. If you give the market enough time, they will adapt and things will change. The real problems occur when it happens overnight or it goes really fast. So the fact that we've had a week now where it hasn't kind of moved really sharply leads me to think it'll be okay. If it was all over the map, if it had gone to 720, back to 715, and then 705, and then back to 725, I'd be nervous. But the reality is that if
they just let it go and we're down a couple basis points every week and it just slowly happens, you just don't think it'll be as scary.
I don't think that's going to be an issue.
You know what? That sounds like words of wisdom. I think you should have your own podcast. Like, that's some pretty smart words of wisdom. Yeah, all right, so let's get to the bond proxies. And you know what? This is the REITs, the XLRE, and it continues to do well, right? I mean, bonds haven't begun their correction yet. I mean, the bonds have shot up, yields have collapsed. We haven't seen the first reaction, but bond proxies, like these high dividend-paying kind of securities, continue to do well. I mean, do you think it double tops, or you think we still have another leg higher?
I think it's going to be tough for these things to head higher. I think they're fully priced. I'm obviously a bond bear. I'm wrong. I think there's better places to put your money than any
so
sort
this
of
is
bond.
the utilities. Yeah, it'll be interesting. Like there's definitely, they have not broken out yet, and so they're gravitating to those highs. But arguably, with bonds seeming to have had maybe potentially blow off top, I don't know. You know, I did. By the way, I did sell all my TLT the other day.
Well, there you go.
And so
you know
that
what?
means it's going higher.
No, Patrick. I took it all off when we had the Trump tweet, and then I was like, I saw the dancing on the grave of all the bond bears that the bulls were doing, and I thought, oh God, I can't help myself. And then when I combined the fact that you got Germany coming out, and I know that the stimulus from the green spending is not that big, but I still think I'm watching for signs that the attitude in Germany is changing. Right. And I think this is the shot across the bow. So, Patrick, you know I don't usually do this, but I bought some puts on the Bund.
What?
Like that? Yeah, I did. I'm straight out like long gamma on Bund puts.
I couldn't. I don't believe
you couldn't do that. I know you.
No, I don't believe you. I don't believe you. This is not the Kevin.
Oh, you don't believe I did it?
Yeah.
Well, okay, so Patrick, I then sold some vol.
There we go.
On the US one.
All right.
I did go to some call spreads on the US one.
Okay.
It's funny. So they're both negative. They're both negative bets, but at least if they go nowhere, I'm decaying the right way.
All right. There you go.
Anyways, there you go. Yeah.
Okay. So gold and gold miners. Look, man, that was quite a week, wasn't it?
Yeah. So I'm going to say this, Patrick. I don't have a position. I know we could head higher, but if you said to me long or short gold from here, I would choose short. How would you feel?
Look, whenever.
Well, I guess it depends on your time frame, and don't forget.
Okay, so what? Here's what I did. For the big picture trading members, we collared it in. And I know you don't like the idea of selling those calls up above on gold, but I wanted to also sell a little bit of premium to help reduce the cost of the put. But look, I'm not going to lose my core gold position. I mean, we bought at the perfect time. We were breaking the 1300 breakout. We bought it perfectly. This is getting long in the tooth. I feel like I don't want to lose the profits I made on the short term because it's overbought, so it's going to pull back. I just think that the bigger gold bull market has begun, so a pullback is just a buy on dip. And
so I agree. But I really kind of think to myself that we might see 1400 again. and get everyone bearish.
1400 is just a consolidation we were at a week ago, dude.
But that's
Like,
what
that's
I think.
not
I
that's
think
not
we
a
could get
bear
that
call.
and then get it. No, I know. But then we get everybody really bearish. People say that was the top, and then you start buying it again. I'm with you longer term. I'm a huge bull. And don't think I'm
It's
short
overdone.
gold.
It is overdone.
I'm not short gold. I'm never short gold. It scares me too much. I just I consider myself.
That's why there's that big right tail on the skew, right?
Yeah, I figure when I'm not long that I'm actually short. So that's basically that's basically what I get. Okay, so number one was at the market top.
I still think it is
the stock market top.
Yeah, I still. think
you know what?
Okay, please flip flop, please. It never works well when we're both in agreement. So I would welcome you to go bullish, please.
I'm not bullish. I'm not bullish. I was really bearish. I don't know anymore. I'm not as confident about my bearish.
Even after hearing Barton?
No. So after hearing Barton, it makes me think I got to sell it at the end of the month.
So you're long till end of August.
I'm not long. I'm not long. No, I'm not long.
Just
Don't forget, I was really short, and I brought some in, and I'm just saying I'm not sure that we're here yet, and I don't know.
But do we break above 3,040?
Well, first of all, you know me. If it breaks above 340, it's not going to make me bullish. It's going to make me bearish.
Because you're going to be like
prairie dog.
Yeah,
because all you guys will be chasing it, and I'll be like, okay, everyone's now bullish.
You guys, I'm going to get bullish.
Yeah, I know you're never gonna. You're like Charlton Heston. You'll take, you'll make me buy this position back out of my cold dead hands.
All right,
that's what you're like.
Yeah, but I don't think we go back above 3,040. Now, you actually still think a prairie dog's possible?
I think that there's a chance that we go above that in the next 2 weeks. Yes, I do.
Okay.
But I don't. But that won't make me bullish. But that won't make me bullish.
Thank you. I respect that opinion that it won't make you bullish. But I think though we could have a bet on this. Do we prairie dog or not? I think this is a good bet.
So. Okay, but I feel like the odds are that
but you said
don't.
Duke and Duke. Oh, what do you mean the odds are? Then you're in my camp.
Yeah, I told you I'm not long. I wouldn't buy it.
We're not. You're not bullish. We know you're not bullish.
Yeah.
I asked you a simple question: are we going to make a higher high? And you said there's a chance.
I just think there's more of a chance than you do. That's all I'm saying.
What is that? So I have a 5% and you have a 10% chance? That's still pretty bearish, dude. What's your odds? Give me some numbers. Come on.
Before the August, like in the next 2-3 weeks, we hit
before
a new high?
Before Barton's TGA account shit hits in September.
I think it's 1 in 4 that we could hit a new high.
Oh my God, that's nothing. Jesus Christ. Okay, we're not even.
This
conversation is over. No, this conversation is over. We're moving on.
Good.
You're bearish. Let's end the story. Okay, so let's get to the top 5 things to watch next week. All right, so number 5, I wanted to talk grains. Now, listen, you're the grain guy. You're much more of a grain trader than I am.
Listen, I'm not the grain guy.
Yes, you are. You're a closet grain. You're a Winnipegger, dude. It's in your blood.
I know. So I am a closet grain freak, and my wife always makes fun of me because I actually would love to own a farm, and I know that there's no money in it and it's stupid and stuff. I actually love cows, and I love this. Seriously.
Do not admit this on the air, dude.
No, I actually listen. I got something to admit. Those Highland cows in Scotland, and it must be my Scottish blood. I love them. And I met a guy at the park, I live in Toronto, and I met a guy at the park that owned some Highland cows. And I swear to God, I would talk to him about his cows for we would walk our dogs together. God. And we would talk about his cows for hours. And my wife is like, you're just a freak. I love those Highland cows. You know the ones I mean with the floppy hair and stuff?
Yeah.
You can't eat them. They're basically no good eating. And there's really no purpose
I
to
can
them.
eat anything, dude. Yeah, that's true. Maybe it's not going to be tender. It's not.
I eat a puffin, so I probably eat my Highland cow too. Truth be told, I'd probably eat it as well.
All right, so let's talk grains.
But wait 1 second. So my father owns a farm, like a hobby kind of. It's not really a farm, but like a property, and I want to surprise him with a Highland cow or 2.
Nice.
Or 3.
Nice.
I think my wife tells me that I'm not allowed to do it, and that would be terrible. But I don't know. I don't know how much these things cost. Are they $1,000? Are they $5,000? I have no clue what a cow costs. But I think it would be the greatest kind of.
Well, why don't we just look at the cattle?
Anyways, if anyone knows how much a Highland cow costs, send me the notes because I want to buy a few for my dad. Now let's go on.
Right.
Wheat and corn. What do you got?
I have an intuition that this is going higher from here. Like, okay, I mean,
Spidey sense, like your Spidey sense.
Yeah, I bought some. I bought some wheat. I'm already long corn. I didn't quit. I got hammered on the downside and I didn't quit. I had some hedges, but I'm long corn and I just bought wheat. I'm thinking, you know what? My spidey senses are saying that this kind of like China not buying U.S. ag was sort of the kind of downside blow off. If this is the worst that comes from that, then it's all upside from here.
Well, they don't buy wheat or corn, buddy. So
I know.
you're already showing your
soya.
problems. It's soybeans, but the reality is that I know everyone will tell me that the farmer's getting more efficient and blah, 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 blah. But if you go look at corn and wheat and soybeans, inflation adjusted, are sitting and trolling at all-time lows. And right. I get it that everyone's getting more efficient. We're figuring out how to grow more and more stuff. I get it. One of these days, we're going to have non-ideal kind of growing conditions. One of these days, we're going to have a problem with the crop, and these things are going to double and triple overnight.
A massive flooding like we saw is not enough for you?
No, we're going to actually have a problem. Like I don't know anything about
I heard that,
corn and wheat.
Am I off base? Did I hear properly that they were talking about corn rations?
I don't know, but listen. More importantly, Lena has just sent me a note. Highland cows are $1,200 to $1,500.
So 3 of them for your dad. That's easy. That's just one good trade.
That's one good trade. That's what I'm going to do. And if he's listening, watch out because I'm going to get you some Highland cows.
Oh, wait. Sorry. I found more.
There we go. Lena's hopping on.
They can go up to $5,000.
Yeah, whoa. See, I know. A good Highland cow is worth it, though. Okay, so there you go, Patrick, who knows nothing about corn and wheat.
But it's from the Fuzzy Wuzzy cattle company.
This is a cattle company in Alberta, I believe. So
the Fuzzy Wuzzy cattle company. That's awesome. That's awesome.
Okay, listen. Corn and wheat.
But look at the soybean chart, dude. You know what? I don't pull out the Fibonacci's very often, but I bet you that's a 61.8.
You pull out
look
the
at this
every day.
61.8 right there, baby.
Okay, so what I like about your trade, Patrick, is how you're fading all the kind of worry about the Trump tweet storm and the tariffs. I like it.
All right.
You're buying weakness.
Buy the dip on the grains, everyone. You heard it here on the Market Huddle first. All right,
number 4.
Copper.
Looks like
we're staying with this commodity. We're doing this big commodity push in this week. All right, so Dr. Copper. Obviously, Kev, why is it called Dr. Copper?
Because it's got a PhD in economics.
Thank you. It's because it's a barometer on the global economy. PhD in economics. And we have a triple bottom. Or is it? Because, Kev?
There's no such thing as a triple bottom.
This is lesson from Kevin Muir, right from the Macro Tourist.
No, you're right. You're right. That is, if I had to bet, I bet it shakes everyone out and does a prairie dog and gets worse.
Just a prairie dog? You don't think there's another leg lower? I think we're going to 2.25.
Do you?
Yeah. By the way, I would be, but with that said, I believe that over the long term, owning copper stocks and shit like this, I love Katusa's story on copper and stuff. I in the bigger picture, I view at the end of this business cycle, you back up the truck and buy any of these copper stocks. It's going to be a great buy.
So you're just arguing that we're still ways away from the bottom.
I just believe that we have another leg lower coming, and if I see copper at 2.25, I'm buying. I'm just going to load the boat.
Okay.
I think it's going lower first, buddy.
Okay, I'm not touching it. I have no opinion.
Right here, you do have an opinion. There's no such thing as a
triple bottom.
So you do have an opinion.
There you go. I guess I do.
So you're bearish.
I guess I have to be. Number 3. Let's go.
We're already drunk at this point, right? Like this
I
is
don't know.
this is
You're
when it
always a
gets
lightweight.
this
So
gets stupid.
you always have more trouble than me at this point.
Oh
Okay,
my God! All right.
So number 2 is or number 3. Sorry, is the 210s. Is it invert? I think this is a really good question.
Like
first of all, it was ugly on Trump's tweet. It got really ugly.
And you were saying that like when we were talking, you thought that was just a blow off, and it just keeps going, dude.
Yeah, it's not looking good. I agree. Like, listen, it's first of all, this thing carries positively. So like you have to remember that you're looking at this as price, but if you're holding it, it's not as bad as it looks.
Yeah.
Next thing you have to realize is that, do you really think if this thing inverts that the Fed, and we just had Barton telling us how the Fed has to cut rates because of the problems with the foreign whatever it is account that he's talking about. The reality
I believe the steepener is the trade of the next 2 years. The question is where's the start?
You know what worries me about the fact that my steepener trade, Patrick? I'll tell you that my biggest concern is that everyone agrees with me.
Oh yeah, you hate that. You hate that.
I do. I'd rather have people.
But the problem with that is that this isn't the opinion on a commodity or on a stock. Like the thing is that most people have no clue what they're talking about when they're talking yield curves. They just spew shit from that they hear, right?
As opposed to us, like that we're
we know exactly what we're talking about, right? Like we do like Barton style heavy analysis, right? Yeah. Like anyways, I just think that people's opinions I don't think are as important in this trade as you think they are. But sorry, go on, make your point.
Well, I'm going to ask you, do you think it inverts?
I think so. But with that said, I think that the steepener is the big money. Like, look, I think on the short term, we're approaching these lows. I mean, we're only 10 basis points away. It could still invert, but the asymmetry is still trading the steepener. That's where the real money is.
So do you think that it inverts? Let's just imagine this thing all of a sudden spikes 20 basis points lower, and we're trading minus 10. Do you think the Fed panics at that point?
I don't think it's a panic.
I do.
You think they panic? Like, okay, then why are they not panicking the fact that this 3-month against the 10-year is already been inverted? We're like a freaking minus 25. We were at minus 40 basis points in this one, but they're not panicking now. Why is the 2 year so important?
I think they're close to panicking.
Yeah, but why is the 2 year the one that they're going to give a shit about?
I don't know.
Dude?
I don't know where it's going to be, where they're going to panic. I just think they're closer to panicking than we think.
I think we should just get Barton to tell us what this kind of thinks.
Well, I could see them panicking in September if things get ugly.
Well, listen, that's definitely on the table. But you know what is interesting? Just on a quick side note, the Canadian 2s and 10s are inverted. Did you notice that?
Well, the whole curve in Canada is inverted.
Yeah,
things are ugly here. Like I think that people are missing the fact that Canada's like not doing as well as we think it is. And Patrick, I got to tell you something. You know what I took a little off of today?
Please tell me.
Australia CAD. I took a little bit off.
What? Oh, you're that bearish on the CAD.
I'm nervous. I'm nervous for the first time.
So just go long the dollar.
You know what? I feel like it's been a good trade, and I should just, ring some register while it's there.
Dude, anyways, by the way, that was a good call. That was a good call.
Even the blind squirrel finds an acorn every now and then.
Oh,
Number
absolutely.
2, what do we got?
Emerging markets.
Yeah, submerging markets.
Submerging markets. There was that one tweet by Raoul Paul that's kind of I think he drew this trend line right here. I think it was just like along these bottoms. But I mean, like any technician could draw a little connecting bottom line. But the bottom line is that it got slammed in the last week and a half, right? 2 weeks. That was a pretty heavy break to lower lows. But what's interesting to me, like one of my major narratives with my members have been essentially that emerging market materially underperforms developed markets, right? Like I felt that was a really strong theme. The fact that we are basically at very close to multi-year lows this quickly. I mean, the S&P has had a correction, but it's nowhere near December lows, and it's nowhere near multi-year lows. And the emerging markets are ready to go. Like, they're so weak. Now, I mean, I know there's huge value in emerging markets, but there is just no money flow here. No capital flow going into this space at all.
I know, and that's one of the reasons that I get nervous about the U.S. stock market. I just don't know how long that can continue. I feel
you think that this spills into U.S. equity?
If you said to me like the emerging market versus S&P trade, do you want to buy that or sell that? I would very definitely choose long emerging markets, short S&P, and I know that it goes against the Brent Johnson view.
My head's exploding. What?
I know. I know you guys feel that way, but I just don't know how long this can continue.
Okay, well, the only thing you've got going for you is the S&P is starting from a much higher base, right?
Listen, you just can't keep attracting that much money and not. Anyways, it doesn't matter. Everyone knows the arguments. Let's not worry about it. Let's go to number one.
Stop for a second. Do you really believe that it and then let's just maybe we'll do a Duke and Duke here, but you honestly think that by year's end, from this moment, that the S&P can that the emerging markets will outperform the S&P and the S&P?
I don't know about 1 year. I don't know about 6 months. You're giving me less than 6 months. You're giving me 4 months, like almost a quarter. But if you gave me 2 years and you said you can be long emerging markets or you can be long S&P, it's not even close for me.
Okay, and you know what? I won't take the other side of that, because the reason I think that once shit finishes hitting the fan, the emerging markets are immense value. Like there's going to be a point where you want to buy emerging markets. It's just right now it looks like shit.
Yeah,
I mean and so if you're going 2 years out, then I can't take the other side of that deal. I would take it for 4 months.
I'm not going to do that. I've learned my lesson of like doing that. I'll probably lose the
number
bet
one
by this weekend.
Number one.
CPI, inflation, and retail sales. So,
dude,
CPI,
I'm crushing you. I'm crushing you on this bet.
It's not looking good on the CPI.
So just for our newer listeners, Kevin and I made a bet earlier in the year, and it wasn't a stake. No, it wasn't a snake dinner. It was you're taking one of us is taking the other one plus 5 of our Market Huddle listeners. By the way, all of you are free to submit your petition to be one of the 5. Huddle listeners.
Once we get closer, we'll figure out how we're going to do it.
But
we're going to go drinking. We're going to go drinking
on night drinking on the other guy's tab.
Yeah, it's not looking
no
good
food, no food, just booze.
No food.
But and we won't do like those expensive bottles of wine and scotches. It's
we're just beer.
Just drinks, just beers.
Just beer.
But one night of beer drinking,
especially with the bond market doing this, I won't be able to afford much.
So okay, back to the numbers. Okay, the PPI came out, it wasn't good.
Yeah, there's no inflation. Listen, I'm wrong.
Thank you.
It's not common.
You know what? I have nothing else to say. You just said all I had to say. You're wrong. Okay, that's fine. Okay, so do you think at all that it upticks before the end of the year, or do you already concede that you're going to lose?
I'm not going to concede because
by the way,
just give away the free call. But like if I had to make the bet again today, obviously it's not looking good. It's looking like a dumb bet.
So just so our listeners know, we're doing an over/under of 1.9 for the year.
Yeah, it's not looking good. Like my inflation narrative has been like a pipe dream.
Yes, and Jon Snow just took care of business.
Yeah, I was beheaded, like with that call. It's been a bad call.
You'll eventually be right, but just like like your wife says, you're just too early.
Yeah. Okay. Anyways, on that note, let's call.
Well, retail sales though.
Oh, sorry.
Do you consider retail sales to be one of these indicators that will start to show the cracks in the armor already?
I think that So if I had to guess,
that's okay
on
if you
market,
don't have an opinion.
No, but it's okay. If I had to guess, I would guess that the U.S. is not going to do as well versus expectations as the rest of the world is going to do versus expectations. And it's very key here that you realize that I'm saying versus expectations. I feel like the world is the markets have priced the rest of the world for the end of the world, and the U.S. as the economy that's going to hang in there and do better. And so whether that manifests itself with the rest of the world picking up, or whether that manifests itself with the U.S. slowing down to the rest of the world, I just think that's the way we're headed. I'm not sure which side of that kind of spread I would try. So
let me ask you this. CPI, right here, the forecast is, I can't believe this, 0.3. Are you taking the over or under?
You got to take the under.
Okay. So then retail sales. They're also saying 0.3 is the forecast. It came in 0.4 the last time around. 0.3. Do you take the over under?
I got to take the under. I actually think that there's been a lot of damage with Trump's tweets and all this uncertainty, and people aren't going to spend.
All right. The problem is both me and you agree, which is dangerous. It's dangerous.
Yeah. No, you're probably correct.
Sorry for all of our listeners.
Yeah, when the U.S. economy just
takes off, then it
explodes from here. You're gonna know. Anyways, let's go on to this. The
parting words of wisdom. What do you got?
I got Bruce Kovner, which I actually am a big fan, and he talked a little bit about what he looks for, and he says, "What I'm really looking for is a consensus the market is not confirming."
I like that.
And I thought that was actually really wise because what I think he's trying to say is something where everyone tells you that this is going to happen, yet the market is behaving differently. You know what I mean?
Yeah. No, listen. You know what I always say to my members. I always say the key to making money is asking the question: what does everyone believe to be true that just ain't so?
Yeah. Which, interestingly enough, everyone thinks Mark Twain said that, but there's somebody else that actually said that.
Really?
Yeah, I keep, people attribute it to Mark Twain, and then Barry Ritzel.
No, Mark Twain did say something like that.
No,
it was different.
I don't know. Anyways, it doesn't matter.
But he did. But maybe he did. Maybe it was an original to him. But he did say something like that.
Maybe said it as well. Anyways, keep that in mind.
But I just stole it. It's my line now.
Yeah, just watch for
you heard it here
where everyone's telling you something, and the market is not behaving that way. And that's often the first sign, right? Like that something is changed, and that you should be watching for the surprise to be the other way.
All right. Okay. Well, that was a good episode, wasn't it? Well, Kev, where can people find you quickly?
Oh, that's right. At Kevin Muir on Twitter or themacrotourist.com.
Right, and so by the way, everyone should first of all follow the Market Huddle. No, just Market. Was it the Market Huddle?
No, it's
on
Market
Twitter?
Huddle. No. The Twitter is the Market Huddle.
You have to put the in there, right?
Some individual has Market Huddle and hasn't tweeted in a long time, and he should just he or she just give it over to us.
Concede it.
Yeah, we should actually try to convince them.
Yeah, we should. And we should put a petition. It's too late. All right, but you could also follow me at Patrick Ceresna or go to bigpicturetrading.com. And that was by the way, and also everyone should by the way register on the markethuddle.com website for the email, because what we do is that those great presentations you saw from today from Tony and from Barton. The slide decks are included in that email. So if you really want to go back and review some of this stuff, you're listening to the podcast and you want to see the visuals on this, there's only one way to get it. You get the email. And the only way to get the email is to register. And so you got to go to the website, register, and then you're done. And we don't solicit you and put junk into your email. It's just we send you when the new show is released, when Lena finishes editing it and sends out an email, and you get all this great content. So make sure you do it. Otherwise, I have nothing else to say, Kev. And what do you have to say?
Nothing. Thanks again to Tony and to Barton. And great show. Patrick, will see you next week.
More Tony next week, right?
Yeah.
No, next week. In the after hours. All right.
Anyway, in the after hours.
All right. It's time for the after hours show with Tony. Welcome back here. Tone. It's I've had many times had the opportunity to have a few pints with you, and as you come out to Toronto and a number of Canadian cities when we present at all the different options education days. And by the way, for all of our listeners that want to meet Tony in person and can make it out to the Toronto Options Education Day, it's on September 14th, right, Tone?
That is correct. Right? Yes, September 14th.
So it's in Toronto. It's hosted by the Montreal Exchange. You get to hear Tony and myself talk about options. It's a great experience, and so make sure I'll send out a link in our Huddle emails for those people that are looking for it. But it's going to be fun when you're up here. We're going to go for a pint.
Yeah, absolutely. On
right, that's fine.
Either the 13th or the 14th. And also for those of you that are in Vancouver and Calgary, we will be out there on November 30th and December 1st, I believe.
Right. Exactly. Yeah. So Tony, while you come up to Canada all the time, you're a New Yorker, right?
I am a New Yorker. I grew up here, and I don't think I will ever leave.
That's not true. You told me you were thinking of going to Australia.
That is true, but after thinking about it, I think New York will always be home.
All right. No, good stuff. Well, what do you like about New York that's so amazing?
I do a fair amount of travel, and there are a lot of places in the world that I love visiting, but there's just no place like New York from the perspective of just everything is available to you 24/7. And the fact that I grew up in that environment, when I'm away, I get anxiety whenever things close at 10 o'clock. I'm always that guy at 9 o'clock saying, where do I get food? What if I'm hungry at midnight? What do I do? I think people make fun of me. I get food anxiety at night. But
hey, so Tony, it's funny you say that because we had Rob Koifman on, and he was the same way. He's a New Yorker, and he was living in London, and his big complaint was that everything closed at 10 o'clock. What is with you New Yorkers thinking you have to have a meal at like midnight?
I don't know. It's just growing up here. That's what you're used to. And when you're told that you can't have a meal after 10 o'clock, you get anxiety.
It's like, screw you guys. I can't eat at 12.
Exactly. We can get
this place is shit.
We can get delivery at 4 a.m. any single night of the week. And it's just, we're accustomed to.
It's actually amazing because he said exactly the same thing, and it was unprompted. And the fact that both of you guys were complaining about the rest of the world means that you New Yorkers really are an unusual bunch that way, and that you feel like you have to have all 24 hours food available all the time. Otherwise, the city's crap.
So Tone, I'm going to be in Manhattan in a couple weeks. Where you got to tell me where to eat. Like where's you're gonna have to. I'm gonna go with the family, so I'm gonna need something that's like family friendly. But you got to tell me where I should go to get a good New York experience.
So, do you guys have a preference on cuisine? See, that's one of the things about New York, right? People come here and they say, "Where should I eat?" And there's literally a million places to eat that I don't even know where to start. So it really depends on, number one, where you're staying, right? Are you staying in the city? Or are you staying somewhere else?
We're in Manhattan.
Manhattan is a big place, Patrick.
Yeah, I don't know. Like I think Chelsea or something like that.
Yeah, but Chelsea's a lot different than Uptown, buddy.
Is it?
So
yeah, I guess it.
Yeah.
So number one, my new thing about New York is that New York has started to do what Australia and Asia has been doing for a very long time, and that's food courts. Food courts are some of the best ways to, in my experience, to experience New York food. So if you're going to be in Chelsea, you have to go to Chelsea Market. There's a phenomenal Israeli place that I will tell you. I'll send you a separate email on how to go on that place. There are some great noodle places, but it's the best way to try a bunch of foods in New York, in my opinion. And all of a sudden, there are, I want to say, like 8 or 9 really good food courts that have popped up in New York. Historically, it's not a thing. It's really only an Asian thing. But some of the best food you get are in food courts in Asia, and New York is finally starting to catch up.
My 10-year-old son will insist that I get him a cheese pizza, so you'll have to tell me where to get him one of those two.
You got to go to Joe's Pizza. They have quite a few locations, but Joe's Pizza on Bleecker Street. Get the Sicilian slice. It is the best thing ever.
Nice.
One bite. You know the rules.
One bite.
Yeah,
all right, let's talk some markets.
Okay, let's talk some markets. Exactly.
So Tone, like, what do you make of what's going on here? Do you follow some of these different commodities and stuff? Like, obviously the dollar's moving a little bit, but the stock market rolled over. But do you have any opinions on what's going on, like in crude oil or any of these other markets?
So gold looks a little overbought right now. Crude is an interesting commodity right now because right now the trade war certainly has hurt demand, but we're hearing about OPEC potentially trying to cut supply, which will obviously help oil prices. But I think overall, oil prices are potentially heading lower. 50 is really kind of a big support level. We've been having lower highs with 50 as that major support level. I think if we break down below 50, you're going to start seeing 45, 44, those types of levels to the downside.
Right. And do you have a particular opinion about these energy companies?
Ooh, energy is still by far, the worst sector. It's a sector that I haven't really touched recently. I did go long Halliburton a couple of weeks ago when things started to look like they were starting to come
when it
back
had a little
higher.
gap.
Yeah. Obviously, that trade didn't work out. That's the only thing that I've touched in the energy space. I'm just looking at a chart right now. It looks like Schlumberger, Jay, Halliburton are all making all-time lows. This is a sector that I have not touched very much, other than trying to go long a couple of weeks ago, and that did not work out.
So you're gonna wait for like the relative strength for this sector, the whole sector, to turn around, and then you'll start paying attention. Then, are you waiting for the first bottoming formations to start developing here?
Yes. So as far as for me to go long a market, I try to look for some form of relative strength. And I thought energy was starting to show that, but it just collapsed right after it started to show a little bit of strength. But a lot of my trading is very quant driven. So I like to find things that are relatively severely oversold, sell put spreads on those types of stocks. Or stocks that I see have completed a bit of a bottoming formation for me to go long.
Yeah.
Statistically, that's just what our models, seem to favor.
All right. So you said gold is a little oversold. Overbought. What's your take here? I mean, are we? There's a short-term top coming in here potentially. What's your feeling on gold?
I think selling call spreads on gold, can potentially be a favorable trade for the next few weeks. I think that this what's GLD at, about 141 to 142. I think selling 142, buying back 145, 146 type call spreads makes a bit of sense on a small pullback. I haven't really looked at the dollar index lately.
But when you open a credit spread, do you allow it to go in the money and just give it a little breathing room if it's on the short term going against you, or do you really just want to see the trade start working in your favor right away? Like, how do you manage a trade because 142 is pretty tight, right? Like, when do you make that distinction that you're a little bit early? When do you pull it and go to the sideline? And what duration do you put on these types of credit spreads?
So with credit spreads, we've done a lot of quant research on backtesting credit spreads. And from our perspective, the best credit spreads are selling at the money. So I would actually even go maybe 142, 141 and a half, maybe even the 141s, considering we're just, 19 cents shy of that 141.
Slightly in the money, right?
Yeah. Because what you really want is for the risk on a credit spread to not be greater than 2 times the income that you receive. If you're risking more than 2 times the income that you receive, it's really difficult to make money in this strategy in the long run because of that negative risk to reward ratio. So if I'm selling credit spreads, I want this thing to be in the money. I want this trade to be working in my favor immediately, or else I'm cutting my losses and I'm pulling the cord on this.
So what would you say how often are you more of an income trader versus a directional trader, where you're how often are you short theta versus long theta?
So I would say that nowadays I'm saying,
and that's personal. Forget what you publish. Like you personally, like when you're managing your own personal account, are you more of a premium harvester, or are you more of a directional trader?
So I should say that I would say I'm close to half and half, but when I'm long theta, I'm always long theta through a spread. I'm never long theta outright through a call or a put. I'm always short something on every single trade, right? So I would certainly say that slightly more short theta trades than long theta trades would be my preference. And for the most part, when I'm selling credit spreads, which is predominantly what I do on the short theta side, it's more so on the put side than I do selling calls, simply because of the fact that, if you look at the market, right, I think over the last 30 years, the percentage is like 56% of 55% of weeks are up. 45% of weeks are down. So immediately you have a skew to the upside in terms of probability, right? So puts, just from a directional perspective, have a higher probability. But in terms of selling a credit spread, you're short volatility. So if you get a bounce in the stock, that typically will be a collapse in vol. Versus if you're short call spreads, when the stock declines, that usually is a decline. It is usually a decline in volatility. So we tend to find that put spreads work a little better from a probability perspective in the long run. But gold is a little different, right? Because it's not an equity. It's so that's where
what's really fascinating about gold is it's got the right tail skew on the vol, right? And so normally you're dealing with left tail on most equities, right? And so selling call spreads on gold has a completely different dynamic than doing call spreads on a normal equity, right?
Right. And so I'm just looking at a call credit spread on gold right now, and the risk reward doesn't look particularly strong. Usually, call spreads you can get 1.5 to 1 risk reward on a call credit spread, but on gold it's close to 2 to 1. So not a particularly attractive trade in my opinion from a probability perspective.
Well, that's because of that right tail, right? Because
yeah, exactly.
What's happening that vol premium is so high on the side there. Now, just so you know, Kevin, when he does do options, he's always a seller, right, Kev?
That's not true.
How often do you go long an option?
Very
not
rarely,
often.
Not often, but listen, I will buy. Like I was long fixed income vol. I'm long FX vol. If I think that it's fundamentally mispriced, I just don't regularly go out and buy S&P vol because generally, if you look over time, it trades below and like realized. Right. And I get it that it like I understand all the. If you time it, and I understand why you might want to be long, but it's just I grew up cut my teeth and eye teeth on an institutional equity derivative desk, and we were always seller of all, and it's hard to kind of change your habits. So.
Once you were indoctrinated that way, it's hard to.
You guys have just never been on a desk and bleeding theta. And as much as what
do you mean? I'm long as straddle. I know what it means to bleed theta.
Yeah, but wait till you really bleed theta. Like you're like, oh, I bought I remember buying 8%, going, this is so cheap. Like there's no way we're gonna make money. And we went long all sorts of theta, and getting up every day and just looking at this and watching your P&L just drift away. As you just lost every day. I saw someone the other day that said something like, "I bought the low, sold the high, and I'm still down because I'm long theta." And like and that is what's going to happen. Like if you just don't get the moves, you're just it's difficult. And on the whole, people overpay for equity index vol at the very least.
Yeah, so that's I will say long theta, one of my favorite markets to go long theta is actually currencies. My background's in currency trading. I was a spot currency trader for a very long time. I don't like trading spot currency. I like trading currencies through options because spot currency is difficult to trade, but I can take a directional view, because currency vol is very cheap to purchase. And you can buy these long dated, currency options for next to nothing and be able to take that directional view with limited risk. So currency is one of my favorite markets to buy calls and puts on.
Okay. All right. So one question for you here, because I don't know if you listened to the show, so hopefully you didn't. Would you be going long or short the pound here?
So I still
Do you have an opinion?
It's hard to go short when it's down so much, but I've got to say short because
nice.
There's no chance in hell. There's no chance in hell these guys are going to walk away with some sweetheart deal. Things are going to get fucked up over there.
I love it. He's got passion in his voice here, Kev. You
Yeah,
know
I know,
what?
but everyone has passion in their voice about that. It's all in the price. That's all I'm arguing.
Oh my God.
And the fact
It's all in
the
the
fact that
price
another
on
person says it
August
doesn't
9th.
make it just makes me feel better about my trade.
Oh my
Patrick.
God. Okay,
So what, you're
Tony,
long-
you got to understand.
Are you long
I
British
think the
pound?
pound. I think that you should be erring on the long side here. Yeah.
Oh my God! You know what? You make me sick, Kevin. Maybe. Listen, maybe. You know what? Maybe I'll eat my own words. We'll see. But you know what? You've been wrong ever since you made that bet. I mean, what are we down 200 pips since you opened your mouth a week ago?
Yeah. Listen, it's not going well. Like I'm not going to deny that.
Are you long spot?
On pound, I'm actually short euro.
Euro pound?
Pound.
Oh,
right
the
now.
the Jaguar Mercedes or whatever you call it.
Yeah. I call it the Jaguar Mercedes trade.
Anyway, but like, dude, you know what? I love the fact that you like to fade these things, and honestly, I think it's awesome. You just are always too early. Like you just.
That's what my wife says all the time. So Tony, I actually will agree with you. One thing that I think that if there's something that I would tell a lot of people that trade options on, if you're going to buy them, always go sell like if you're going to buy a put, go sell something on the other side, way down and out. Because I completely agree that too many people just buy outright and they're just long without it being a spread. And that's when the theta really kills you and stuff. So I'm a big believer in trading, call
okay,
spreads,
but you take away some of your delta. So when you put on a spread, do you go and double the position? Like what do you do?
Oh
Tony?
yeah, I'll trade more for sure.
So you'll trade larger size with a spread rather than smaller size with a
because
pure
for
direction?
me, think about Patrick. You just said that I'm always fading stuff. If we're going to be down 15-20% in the stock market, chances are I'm going to probably be long, not short. So why would I want to buy an option where, unless I think that there's like a chance that we're going to get that sort of outsized move? If I think that at that point I no longer want to be short, I might as well sell it now.
Yeah.
And I'll do it through a spread. Now, we've talked about this before, Patrick. I actually feel like you're giving away the on gold. I wouldn't give away that. I wouldn't do a call spread on gold. Because to me, I feel like gold is
because I've collared before, and you don't like that.
Yeah,
you don't
I kind
like
of
the
feel
collar.
like I kind of feel like now you might say that the same occurs with the stock market. If we're going to be down 10%, then why we might go down 20%, and then you're going to have given away. And maybe you're right, and I understand that argument as well. But for some reason, I don't feel the same way about. I just don't feel the same way about gold.
Yeah, because you're super bullish. You're anyone with that.
I think
kind
gold
of a
could go to
bias.
go crazy, and I don't want to be sitting there with the kind of the call spread, watching it as it doubles in my face.
Yeah. I totally understand. My gold trade, I was meaning over the next couple of weeks. I think long term, gold is headed to 170, 180.
Yeah. No, listen, I understand what you're saying, Tony, and I like the fact that you said I'm going to sell some call spreads here. I understand that trade. It's basically the same. I did a similar trade. I did call spreads on the long bond.
On TLT?
Yesterday, I trade futures, so I did it on their future, the real future. The long.
Or
I
did
did
you
the
do the
ZBs.
ultras?
No, I did the ZBs.
Got it.
So I go and I did that, and I agree. It's to me they're kind of trading the same. It's almost the same trade right now. So
yeah, because it's kind of a risk on, risk off thing, right? I think.
Yeah.
Do you think?
Well, it's gold's going up because right now gold's going up because yields are going down so fast. It's a real rate trade. Like gold actually moves very, very similarly to the inverse of the 5-year real yield. So, but I look at this and I go, I'm scared because volatility's gone through the roof, but I don't want to pay up for buy puts because I hate owning vol, and I'm like, okay, if I'm gonna short something, I'm gonna short it, and I'm gonna do call spreads on the ZBs or the USs. I don't know, so that's how I did it, and I think it's almost the same trade as your gold, selling call spreads on gold. So I think it's a very similar trade. Yeah.
Right.
Well, I mean, they're very overbought markets, and so. But the problem is that trying to catch a top is not easy. You know, like I've had a number of people that have been emailing me asking whether they should, buy puts or short either of those two markets, and then day after day the market just keeps going higher. Even after it's like trying to get that. Like, it's always surprising how far these things can go.
For sure, look, but that's why selling the call spread, I know what I can lose.
Yeah.
Like I sell a call spread and I go, okay, so I'm selling like a $2 call spread for $1. I don't know what the number is.
So like
I know
Kev, I know you. Like, you correct me if I'm wrong, but you would do something less than 45 days on your spreads, right?
Oh
like
shit! I did this month. So I'm like 2 weeks.
Yeah.
So I love the Theta Monster. I love the Theta Monster. Yeah, working for me.
So, Tone, what's your average duration on a trade like that? Like, do you go a couple weeks out, or do you do a month or two? How long out do you go on when you do a credit spread like that?
We'll sell 4 to 6 weeks out, and we'll usually either take profit or cut losses 2 to 3 weeks in.
So 45 days. 45 days.
Yeah.
That makes sense. I've heard that number many times used by many people in our industry that basically I think there's a number of research reports out there that show that theta really accelerates in the final 45 days, and that's where you get that real contraction. And if you go longer, then you're waiting too long.
The biggest problem with selling credit spreads is you're typically selling an at-the-money call or put, and what you get is a lot of gamma risk as you go into the last couple of weeks. So the research behind selling 6 weeks out and closing it out about 2 weeks before expiration is to avoid that gamma risk.
Right. Except for Kevin, who's selling only 2 weeks out.
I sell everything. So I just the question. But I do think if you're going to be long something, you be long the longer dated stuff where there's almost no theta. You could buy some leap. You talked about the leaps on your pot stocks. There's almost no theta in that. It's all vega risk, which is meaning the risk of the implied volatility moving around. Yeah. And that's actually your biggest risk on those positions, like apart from your regular delta or whatever. But like otherwise, it's all vega that you're worried about.
Yeah, I mean it's really delta and vega. You're absolutely right. But the thing about buying near the bottom is that relatively, you're right. I'm trying to model out the vega risk on something like that, but I actually think with some of these longer dated ones, the vega is not as the sensitivity to delta is far larger than the sensitivity to vega. That it's not that big of a consideration for me.
No, you're probably right. You're absolutely right. Okay, so Tony, we're going to wrap up shortly. I'm going to ask you one thing. You said that you were selling some put spreads in a few stocks. Give us two names that we should look at for something bottom picking or picking some names that you think are good put spreads to sell.
So I just sold some put spreads on CMI.
Okay, what's that? I don't even know. I'm sorry. CMI. Was that Chipotle?
Cummins.
Oh, I don't know.
CMG. Jesus Christ.
Yeah, I'm not very good at this.
But okay, so you think that's oversold, right? So yeah, that missed on its earnings on Cummins and nosedives, and you're looking for the bounce. I like it.
Tony, but this distributes diesel and natural gas engines. Don't you know everyone's going electric, buddy? Anyways, I like that trade. Give me, Tony, that was complete sarcasm. I like that trade. It looks like it's into support. I understand why you're doing that, and I am assuming with the move we got it implied that's gone up. What's your second name? What else you like?
I was looking at some of the pharmaceuticals. So ALGN.
The ALGN here. No, that's
not blow it again.
Allergen?
Technology.
Align.
Which it gapped down on some bad.
Sorry.
Yeah, Align.
Align Technology, not pharmaceuticals. Yeah. But I do have some other pharmaceuticals as well.
Like Allergen is AGN. Are you trading Allergen at all?
No.
That gap.
ALGN is the actual trade that I'm trading.
That's Align Technology.
This is the teeth straightener that you wear at night.
The teeth straightener?
It is. Yeah, this is what it is. The Invisalign.
Really? I had no idea that's what they did. Yeah.
I like it. You know what? You're just like, I think it's cheap. Like, I'm going to do it. Okay, there you go. So there's two names. You got a diesel engine and tea straightener. You got them both. They look like they're good put spreads. Tony, it's been a pleasure having you on our show. Why don't you give people one last kind of plug where they can find you to learn more about the different option strategies that you're recommending?
Yeah, so I don't know, Pat, if you still have the screen share up, but
oh no, I don't have it up there. But anyway, yeah. So we have your I have your website up here, Options Play.
And if anyone wants, I think what Tony's referring to is the fact that there is a special code for Market Huddle listeners. And just if you want it, make sure you sign up for the actual Market Huddle weekly email. We'll include it in there. And if not, send Patrick an email. He'll be happy to send it to you.
Oh, thanks a lot for volunteering my email. But anyway, for all of our listeners, you'll get Tony's chart book in your inbox with the email that's coming out. So make sure you take a look and use Tony's links.
That's
sound
right.
good, Tony?
Yep. So
and also make sure if anyone wants to hang out with Tony and me at the Toronto Options Education Day on September 14th, make sure you register and come and check us out.
Thank you so much, guys. This has been a pleasure to be on your show. This has been the most fun market talk I've ever done. I will say I would love to be back at some point in the future, and hope to see you guys soon in Toronto.
For sure. Right. Sounds great. That's what, that's always what a couple of beers and some scotches do to you, to your market talks. Anyways, it's been a pleasure getting to know you, Tony.
You guys are on to something. I'll tell you that.
Take care, buddy. Nice meeting you.
All right. Thanks, Tony.
You too.
Cheers.
Have a good weekend.
Lena.
Hop on. Thank God, Lena, because he's already slurring his words and shit.
It's getting a little messy right now.
Lena, what did you think of the beer?
No, the beer was great. I would drink.
Yeah. We have to do our reviews. Now, I always go last. I'm going first. I'm going to say that this is finally a real beer. It's not a sour. It's not like I can't taste the alcohol. I am going a solid 8.2.
A solid 8.2.
A solid 8.2. That's like a good beer.
What was my highest score I gave? I gave it like a
9.01 or something.
Yeah.
Some stupid number like that.
All right, Lena, what do you think? What are you going to give the beer?
I would give this a solid 9.3. I could
God,
drink
what?
Lena,
you just give out the like Lena, have you got anything that's under 8 yet?
I'm easy to please.
You just like beer. You just like beer. You're like, oh, it's beer. Oh, it's 8. 9.
Or maybe I should
rate
rate it right after the first sip instead of recording for 2 hours and then it's sessionable though. You can drink a lot of it.
Remind me, it was the Fantasy Factory that I gave the high score to, was it not?
I don't know. So what do you give it here, Patrick? Just tell us what you got.
Well, listen, I'm in big shit if I don't score this high. I have a thing because this was brought to us by my good buddy who lives out in Madison, Wisconsin, who we met up at the Chicago when we went out there, and he set us up with this for our sponsors. And he talked so highly of this beer that if I give this a low score, I'm going to look like an idiot. And so
Patrick, I have news for you, buddy.
I look like an idiot on my own?
Yeah.
I don't need a low score to make myself look like an idiot.
So let me get this right. You're worried about what some cheesehead is going to say about your beer rating.
From the dairy capital of the world, right? All right. No, you know what? This one, I'm with you. I'm going to give it an 8.2. I'm not going to the 9. 8.2. It's a good beer. This is a beer. It's sessionable. You could grab a 6-pack of this and have a good night.
Yeah.
So I got 12-pack, and it's a really good night.
Lena, I got a story to tell you. The other night, Patrick and I went out with one of my friends, and
shout out for Dave.
Yeah, Dave. He had never had a sour. He's he's not a millennial.
Wow. So it was an ebb and flow. It was we had ebb and flow sponsored the show before.
I don't know, whatever it was.
We did. We had them, and it did, and it's just a 2.4%. It's like literally drinking Kool-Aid.
Why sucking on it? Why bother drinking it at all then?
It's like sucking on a grapefruit.
It was because we walked into this bar. What was the name of that bar we went to?
Scallywags.
Scallywags. Okay, and so we go into the bar, And we asked if they had any sours because Dave has never, he's a
Oh, no,
listener
that
of
was
show.
the first bar when it was Union Social.
No,
or
no,
whatever
they
it was.
didn't have sours. At
Yeah,
the
that
first
was
one.
Union
Yeah.
Scallywags
For
had
good
the beer.
reason.
Yeah.
And
exactly.
so we went there, and that was Selena. That was the only sour they had on stock. So we would have taken a higher percentage one if they had it, but they only had the ebb and flow one. And well, Dave loved it, didn't he?
No, he didn't. He said if he didn't know better, he would say the beer had gone bad.
He was just being nice.
Yeah, that sounds really nice.
Yeah.
He was just being nice.
Patrick is like, you know what's funny about Patrick is often the millennials seem to like the sours, and Patrick is anything but a millennial. Usually he's just like, he's more like Kramer and Mr. Wonderful yelling at those kids to get off his lawn.
You're the one with Mr. Wonderful's haircut and Kramer's
that's
haircut.
true. Just because we have the same cut, but I'd like to have Mr. Wonderful's bank account is what I'd like. But
Everybody
the
would like
reality
that
is that he loves the sours, and it's awful. It's
his way of trying to stay hip, maybe.
I think he actually doesn't.
I'm
like
trying
them.
to relive my youth. I want to stay young at heart.
Speaking
right?
of millennials, when you guys were talking about the Highland cows, and Patrick mentioned, or you guys both mentioned, you guys would basically eat anything. I was like, oh boy, you guys are losing all the vegan listeners, all the millennial vegan listeners. What are we gonna do about that?
Not much.
Listen,
they
I'm
should find
not
something else. Like,
I'm
going to put my foot down there. Like, nope. You're welcome to do. I'm a big live and let live kind of fellow. Except if you're a cow, at which point I'm going to eat you.
I mean, you've eaten a pumpkin.
You actually
Kind of
should live. You should live in Wisconsin, dude. I should. That's you. What are you doing in Ontario?
Listen. I listen. If you want to live as a vegan, that's fine. I have no problems. I'm really, truly, very much like.
Oh yeah.
Live and let live. Like I don't care.
Quickly put out dose to fires. So
no, but it's true. I don't have any issues with it. I don't know how you do it because a vegan is like a level up from a vegetarian. Like I could almost
that's
do
no
it.
dairy, no butter, no cheese.
Yeah.
No,
that's
I
crazy.
Can't do that. I could be a vegetarian if I was able to like eat the cheeses and eggs and stuff like that. A vegan where I cut all of those things out, I would find it so difficult.
People have debates about honey too, because they're like, "Oh, it's made by bees." And
are you serious?
Yeah,
like the
there's
vegans don't think that you should do that. Oh
there's a huge debate about it. That
No,
honey.
but you know what?
Not
That
really
I
part
could.
of the
I
vegan
just
diet.
personally couldn't do that. I could probably give up like the meat. But I would need to have like eggs and cheese and stuff like that. If I did that, like if you make a great pasta and you put Parmesan cheese and all that stuff on there,
all the deliciousness.
Yeah, all that stuff. Like you turn around and tell me I can't have this because it's made with like bread because it has eggs in it and shit like that. Like that would like turn my life upside down. Like that would, I could. Long as I have bread in my life, I could probably live without.
You're talking to the guy who drives a Hummer. You think we're kidding?
It's getting old. I've outgrown it. I'm gonna have to find something new.
It's gonna break down, and you're gonna have to get some other monstrosity. They won't even make them. You'll be like bidding people on their old Suburbans, the XL version. I don't want the regular one. And can I get the 7.2 liter one? Because I want the really shitty gas mileage.
You guys realize we're almost at 3 hours of raw content.
I know.
Right?
We should probably go.
Yeah.
We should probably go.
This is crazy.
We need live.
Like what the hell? What the hell we talk about for 3 hours?
Not
That's
much.
what happens when you
Not
drink
much.
beers.
Okay. Oh my god.
Well, anyways, it's good seeing you guys. Have a great weekend.
Yeah.
You too.
Have a great weekend, everyone, and we'll be in touch and we'll meet up again. Cheers, guys.
Take care. Bye-bye.
Bye.
Bye-bye.